Momentum trading strategy. Momentum trading is a dynamic strategy that capitalizes on the tendency of asset prices, volume, or other financial metrics to continue moving in the direction they have been heading. At its core, momentum trading operates on the assumption that what goes up tends to keep going up, and vice versa for declining assets, for a period before reversal. This persistence in price movement is known as momentum. The dynamics of price momentum. The existence of price momentum can be attributed to several interacting market dynamics. Supply and demand imbalance. When an asset begins to move significantly in one direction, it often signals a strong imbalance between supply and demand. For an upward trend, demand heavily outweighs supply, causing prices to rise. This attracts more buyers, further increasing demand and reinforcing the upward price movement. Conversely, a strong downward trend indicates an overwhelming supply, driving prices lower as sellers rush to exit positions. Herding behavior and increased attention. Human psychology plays a significant role. As an asset's price begins to trend, it gains visibility and attention from more traders and investors. This increased attention can lead to a fear of missing out, FOMO, among potential buyers, or a panic selling among holders of a declining asset. This collective behavior, or herding, amplifies the existing price trend, creating a positive feedback loop where rising prices attract more buyers, pushing prices even higher. Information diffusion. New information, whether fundamental, e.g., strong earnings report, or technical, e.g., breakout from a resistance level, takes time to be fully absorbed and reflected in an asset's price. Early adopters of this information can initiate a trend, and as the information disseminates, more participants react, contributing to sustained momentum. However, momentum is not infinite. Eventually, the forces driving the trend weaken. Buyers become exhausted, sellers emerge, or new information shifts market sentiment. Identifying these inflection points, where momentum begins to wane or reverse, is as crucial as identifying the initial trend. A successful momentum trader seeks to enter positions when a strong trend is emerging and exit before or as the trend shows signs of exhaustion and reversal. Quantifying momentum, technical indicators. While the concept of momentum is intuitive, effective trading requires objective and quantitative methods to measure its strength and direction. Technical indicators provide these tools, transforming raw price data into actionable signals. We will explore several widely used momentum indicators: rate of change, ROC, relative strength index, RSI, stochastic oscillator, and moving average convergence divergence, MACD. Rate of change, ROC. The rate of change, ROC, indicator is a pure momentum oscillator that measures the percentage change in price between the current price and a price. Code snippet periods ago. It helps identify how quickly a price is moving and in what direction. The formula for ROC is $ROC equals \left, \frac, \text current close, \text close in periods ago, \text close in periods ago, \right, times $100. A positive ROC indicates an upward price movement, momentum, while a negative ROC suggests a downward movement. The further the value is from zero, the stronger the momentum. Implementing ROC in Python. To calculate ROC, we first need historical price data. We'll use the code snippet library to fetch data and code snippet for data manipulation. Download the code on OnePageCode Substack. This initial block imports necessary libraries and fetches daily historical price data for Apple, APL, for the year 2022. The code snippet call helps us confirm the data structure, which typically includes open, high, low, close, ADJ close, and volume. Now, let's calculate the 14-period ROC using the close price. Download the code on OnePageCode Substack. Here, we define code snippet as 14, a common period for ROC calculations. The code snippet method is crucial. It moves the data down by code snippet rows, effectively giving us the close price from 14 periods ago. The formula is then applied element-wise, to compute the ROC for each day. Note that the first code snippet values for ROC will be code snippet because there isn't enough historical data to compute them. Relative Strength Index, RSI. The Relative Strength Index, RSI, is a popular momentum oscillator developed by J. Wells Wilder Jr. It measures the speed and change of price movements, indicating overbought or oversold conditions. RSI oscillates between 0 and 100. The core idea behind RSI is to compare the magnitude of recent gains to recent losses. Average gain, AG, the average of upward price changes over a specified period. Average loss, AL, the average of downward price changes over the same period, expressed as a positive value. From these, relative strength, RS, is calculated. $RS equals \frac \text, average gain \text, average loss $. Finally, RSI is computed using the formula. $RSI equals 100 \frac, 101 plus RS $. Typically, an RSI reading above 70 suggests an asset is overbought, potentially due for a pullback, while a reading below 30 suggests it is oversold, potentially due for a bounce. Implementing RSI in Python. Calculating RSI involves several steps: determining daily gains/losses, smoothing them, and then applying the RSI formula. Download the code on OnePageCode Substack. This block first calculates the code snippet by taking the difference between consecutive closing prices. Then, it separates these changes into code snippet, positive changes, and code snippet, absolute value of negative changes. This distinction is critical for RSI calculation. Next, we calculate the average gain and loss over a specified period, typically 14 periods. The initial average is a simple moving average, and subsequent averages use a smooth thing method, Wilder's smoothing, which is an exponential moving average, EMA, with a specific alpha. Download the code on OnePageCode Substack. This is the most complex part of RSI calculation. It first computes a simple average for the initial code snippet periods. Then, it iteratively calculates subsequent average gains and losses using Wilder's smoothing method, which gives more weight to recent data. The code snippet and code snippet ensure that the calculated series align correctly with the data frame's index, filling the initial code snippet periods with code snippet. Finally, we compute the relative strength, RS, and the RSI itself. Download the code on OnePageCode Substack. Here, code snippet is calculated by dividing code snippet by code snippet. A code snippet is included as a best practice to handle cases where code snippet might be 0, e.g., during a strong uptrend with no downward movements, preventing division by 0 errors. The final code snippet is then derived using the standard formula. Stochastic oscillator. The stochastic oscillator is a momentum indicator that compares a particular closing price of a security to its price range over a certain period of time. It is based on the premise that in an upward trending market, prices tend to close near their high, and in a downward trending market, prices tend to close near their low. The stochastic oscillator consists of two lines. %K line. Fast stochastic. This is the main line and is calculated as $\% equals \frac \text current close \text lowest low in periods \text highest high in periods \text lowest low in periods times $100, where code snippet is the look back period, e.g., 14 periods. %D line. Slow stochastic. This is a 3-period simple moving average of the %K line. It is used to smooth out the %K line and reduce false signals. Like RSI, the stochastic oscillator ranges from 0 to 100. Readings above 80 typically suggest overbought conditions, while readings below 20 suggest oversold conditions. Crossovers between %K and %D are also used as trading signals. Implementing stochastic oscillator in Python. We'll calculate the %K and %D lines using a 14-period lookback for %K and a 3-period SMA for %D. Download the code on OnePageCode Substack. This code block calculates the rolling code snippet and code snippet over the specified code snippet period. These values define the price range within which the current closing price is compared. Now, we compute the %K and %D lines. Download the code on OnePageCode Substack. Here, the code snippet line is calculated. A check for code snippet prevents division by 0 if the highest and lowest prices are identical within the window. Then, code snippet, often the line referred to simply as %K in trading platforms, and the code snippet line, a simple moving average of code snippet, are computed. Moving average convergence divergence, MACD. The moving average convergence divergence, MACD, is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. It is composed of three components. MACD line, the difference between a 12-period exponential moving average, EMA, and a 26-period EMA of the closing price. $MACD \line equals EMA 12, close, EMA 26, close $. Signal line, a 9-period EMA of the MACD line. This line acts as a trigger for buy and sell signals. MACD histogram, the difference between the MACD line and the signal line. It visually represents the strength of the momentum. MACD is primarily used to identify trend direction and momentum and potential trend reversals through crossovers and divergences. Implementing MACD in Python. We'll calculate the 12-period EMA, 26-period EMA, MACD line, signal line, and histogram. Download the code on OnePageCode Substack. This initial step calculates the two exponential moving averages, EMAs, that form the basis of the MACD. The code snippet method in Pandas is highly efficient for this. Code snippet ensures the calculation aligns with the traditional EMA formula used in technical analysis. Next, we derive the MACD line, signal line, and the MACD histogram. Download the code on OnePageCode Substack. Here, the code snippet line is simply the difference between the two EMAs. The code snippet is then calculated as an EMA of the code snippet line itself. Finally, the code snippet is the difference between the code snippet and code snippet, providing a visual representation of their divergence and convergence. Interpreting momentum signals and identifying inflection points. Understanding how to calculate these indicators is just the first step. The true value lies in their interpretation to inform trading decisions and, crucially, to identify potential inflection points where momentum might reverse. Confirmation. A strong momentum signal is often confirmed when multiple indicators align. For example, if ROC is strongly positive, RSI is rising but not yet overbought, and MACD shows a bullish crossover above 0, it provides a stronger case for a sustained upward momentum. Divergences. A key signal for potential trend reversal is divergence. This occurs when the price of an asset moves in one direction, but a momentum indicator moves in the opposite direction. Bearish divergence. Price makes a higher high, but the indicator, e.g., RSI, MACD, makes a lower high. This suggests that the buying pressure is weakening despite the price reaching new highs, signaling a potential downward reversal. Bullish divergence. Price makes a lower low, but the indicator makes a higher low. This suggests that selling pressure is weakening despite the price reaching new lows, signaling a potential upward reversal. Overbought/oversold levels, RSI, stochastic. While useful, these signals should not be used in isolation. In strong trends, an asset can remain overbought or oversold for extended periods. They are best used in conjunction with other signals, especially divergences or price action confirmation, to signal a reversal from an overextended state, rather than just the state itself. Crossovers, MACD, stochastic crossovers between an indicator line and its signal line, e.g., MACD crossing its signal line, %K crossing %D, are often used as entry or exit signals. A bullish crossover, indicator crosses above signal, suggests strengthening upward momentum, while a bearish crossover, indicator crosses below signal, suggests weakening momentum. Zero-line crossovers, ROC, MACD for ROC, crossing above zero indicates positive momentum, and below zero indicates negative momentum. For MACD, crossing the zero line, MACD line itself, signifies a shift in the short-term trend relative to the longer-term trend. By continuously monitoring these indicators, traders can gain insights into the strength and direction of price movements, allowing them to anticipate potential shifts and adjust their positions accordingly. Risk management in momentum trading. Momentum trading, while potentially highly profitable, carries significant risks, primarily due to the rapid and often unpredictable nature of momentum reversals. Effective risk management is paramount. Rapid reversals, the same forces that accelerate a trend, hurting supply/demand imbalance, can also accelerate its reversal. What appears to be strong momentum can dissipate quickly, leading to sharp losses if a position is not managed properly. Stop-loss orders. This is the most critical risk management tool for momentum traders. A stop-loss order automatically closes a position if the price moves against the trade by a predetermined amount. For momentum strategies, stop-losses should be set to limit losses if the anticipated momentum fails to materialize or reverses unexpectedly. They might be placed below a recent low for a long position or above a recent high for a short position, or at a percentage-based level. Position sizing. Never allocate an excessively large portion of your capital to a single momentum trade. Volatile assets, which often exhibit strong momentum, require smaller position sizes to manage the increased risk per trade. A common rule of thumb is to risk only a small percentage, e.g., 1 to 2%, of your total trading capital on any single trade. Profit-taking. Momentum traders must have a clear strategy for taking profits. Waiting for the absolute peak of a trend is often a losing proposition. Methods include trailing stops, adjusting the stop-loss order upwards for long positions. As the price moves favorably, locking in profits. Target prices, setting a predetermined price level where a portion or all of the position will be closed. Indicator-based exits, exiting when momentum indicators show signs of exhaustion or reversal, e.g., RSI becomes overbought and starts to decline, or a bearish MACD crossover. Monitoring. Momentum trades require active monitoring. Unlike long-term investments, momentum strategies are highly sensitive to sudden shifts in market sentiment or news, necessitating constant vigilance. Momentum trading versus trend-following strategy. While momentum trading and trend-following strategies both aim to profit from directional price movements, they have distinct nuances and often employ different tools and time frames. Overlap. Both strategies are rooted in the idea that prices, once moving in a certain direction, tend to continue that movement. They both seek to identify and ride trends. Key distinction: focus. Trend following primarily focuses on the direction and duration of a trend. It often uses simpler, longer-term indicators like moving averages to identify established trends and stays in trades for extended periods as long as the trend persists. The emphasis is on capturing the bulk of a large move. Entries might be slightly delayed, but exits are also often delayed, riding out minor pullbacks. Momentum trading focuses more on the rate or speed of price change. It seeks to identify assets that are accelerating in price, often aiming for shorter-term, more aggressive entries and exits based on the strength of the current price movement. Momentum traders might enter earlier in a trend's formation and be quicker to exit when the speed of the price movement begins to wane, even if the overall trend direction is still intact. Typical indicators. Trend following, primarily moving averages, SMA, EMA, ADX, average directional index. Momentum trading, primarily oscillators L, IC RSI, stochastic, MACD, ROC, which measure the velocity of price changes. Time frame. Momentum strategies can be applied across various time frames, but often involve shorter to medium-term trades, days to weeks, compared to the generally longer-term, weeks to months, perspective of pure trend-following strategies. Complementary nature. It's important to note that these strategies are not mutually exclusive. Many traders incorporate elements of both. For example, a trader might use a long-term moving average to identify the prevailing trend-following aspect, and then use a momentum oscillator to time entries and exits within that trend, or to identify early signs of a reversal momentum aspect. In essence, while trend following is about riding the wave, momentum trading is about riding the acceleration of the wave. Introducing momentum trading. Momentum trading is a strategy that capitalizes on the tendency of assets that have performed well in the recent past to continue performing well, and conversely, assets that have performed poorly to continue performing poorly. Unlike reversal strategies that aim to profit from an asset's price returning to its mean, momentum strategies are designed to exploit the continuation of established price trends. The core objective of a momentum trader is not to predict when a trend will reverse, but rather to identify an ongoing trend and ride it for as long as it persists, exiting when the momentum shows signs of weakening or reversing. The behavioral underpinnings. Market herding. The existence and persistence of momentum in financial markets are often attributed to behavioral finance principles, particularly market herding. Herding behavior occurs when individual investors or traders make decisions based on the actions of a larger group, rather than on their own independent analysis or information. This collective action can amplify initial price movements, creating and sustaining trends. Consider a scenario where a company announces unexpectedly strong earnings. Initially, a few astute investors recognize the positive implications and begin buying the stock. As the stock price starts to rise, it catches the attention of other market participants. Seeing the upward movement, these participants, perhaps fearing they're missing out, FOMO, fear of missing out, begin to buy as well, reinforcing the trend. This creates a positive feedback loop. Rising prices attract more buyers, which pushes prices higher, attracting even more buyers. This herding mechanism can be initiated by various factors. Earnings reports. Stronger than expected earnings can spark initial interest and buying. News events. Positive news, such as a major product launch, a new contract, or favorable regulatory changes, could trigger an initial price surge. Analyst upgrades. Influential analyst recommendations can prompt institutional and retail buying. Technological breakthroughs. Announcements of significant innovations can lead to speculative buying as investors anticipate future growth. Conversely, negative news or events can trigger negative herding, leading to downtrends. The key is that these initial impulses are amplified by collective behavior, creating sustained price movements that momentum traders aim to exploit. The self-reinforcing nature of momentum. The concept of momentum being self-reinforcing is central to understanding its viability as a trading strategy. Once a trend is established, it tends to perpetuate itself through a series of feedback loops. 1. Initial price movement. A catalyst, e.g., positive earnings, causes an initial price increase. 2. Increased attention. The rising price attracts the attention of more traders and algorithms. 3. Further buying/selling. These new participants join the trend, pushing the price further, or in the same direction. 4. Positive performance metrics. The continued price movement leads to strong short-term performance metrics, e.g., high percentage returns over a month. 5. Attraction of trend-following strategies. Quantitative models and human traders employing trend-following or momentum strategies are triggered by these strong performance metrics, initiating further buy orders. 6. Media and public interest. Sustained price increases may attract media attention, drawing in even more retail investors who are less informed but want to participate. This cycle continues until a significant counterforce emerges, such as unexpected negative news, a shift in market sentiment, or profit-taking by early entrants. Identifying momentum. Bridging theory to practice. While market herding explains why momentum exists, a quantitative trading strategy needs concrete ways to measure and identify it. This is where technical indicators come into play, providing the bridge between the theoretical concept and practical implementation. Momentum traders often look for assets that are in the top and bottom quantiles of the price move over a specific look-back period. This phrase refers to assets that have experienced the most significant positive for long positions or negative for short positions. Price changes relative to other assets in a defined universe over a recent time frame. For example, if we were looking at a universe of 100 stocks, the top quantile might refer to the 25 stocks with the highest percentage price increase over the last 3 months. Conversely, the bottom quantile would be the 25 stocks with the largest percentage decrease. Common technical indicators used to quantify and identify momentum include rate of change. ROC. This is one of the simplest and most direct measures. It calculates the percentage change in price over a defined look-back period. A positive ROC indicates upward momentum, while a negative ROC indicates downward momentum. For example, a 12-period ROC would compare the current closing price to the closing price 12 periods ago, e.g., 12 days, 12 weeks. Relative Strength Index, RSI, developed by J. Wells Wilder Jr. The RSI is a momentum oscillator that measures the speed and change of price movements. It oscillates between 0 and 100. Traditionally, RSI values above 70 indicate an overbought condition, potential for reversal, and values below 30 indicate an oversold condition. However, in momentum trading, a strong and sustained RSI above 50 or 60 can also be interpreted as a sign of strong upward momentum, indicating the asset is actively being bought. Moving Average Convergence Divergence, MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of an asset's price. It is calculated by subtracting the 26-period exponential moving average, EMA, from the 12-period EMA. A 9-period EMA of the MACD, called the signal line, is then plotted onto P of the MACD line, functioning as a trigger for buy and sell signals. When the MACD line crosses above its signal line, it suggests upward momentum. When crosses below, it suggests downward momentum. Volume. While not a momentum indicator itself, volume plays a crucial role in confirming the strength of a price move. Strong price movements accompanied by high trading volume suggest conviction behind the move, indicating that many participants are actively buying or selling. Conversely, a price move on low volume might be less reliable and could indicate a lack of broad market interest, making it less likely to sustain momentum. A true momentum play often sees increasing volume as the price trends. Timing momentum trades, inflection points, and challenges. A key challenge in momentum trading is identifying the optimal entry and exit points. Momentum traders seek to enter a trend as it is strengthening and exit before it reverses. The points at which a trend might accelerate, slow down, or reverse are often referred to as inflection points. Entry inflection points. These are moments where an asset begins to show signs of accelerating its price movement, confirming the start or continuation of a strong trend. This could be a breakout from a consolidation pattern, a cross above a key moving average, or a sudden surge in volume accompanying a price increase. Exit inflection points. These are moments where the momentum appears to be waning, suggesting the trend is losing steam or is about to reverse. This could manifest as a divergence between price and a momentum indicator, e.g., price making new highs but RSI making lower highs, a breakdown below a support level, or a significant increase in volume during a price decline. Precisely timing these inflection points is inherently difficult. Markets are dynamic and unpredictable. A common pitfall for momentum traders is entering too late, after much of the trend has already occurred, or exiting too early, missing out on further gains. Another challenge is distinguishing between a temporary pullback and a genuine trend reversal. This difficulty underscores why robust risk management and position sizing are paramount in momentum strategies. Unlike reversal traders who profit from a return to equilibrium, momentum traders must accept that they are attempting to catch a moving target and exit before it stops. The art and science of quantitative momentum trading lie in translating these conceptual ideas of herding behavior, self-reinforcing trends, and inflection points into systematic, rules-based algorithms using the aforementioned technical indicators and volume analysis. Diving deeper into momentum trading. Momentum trading, at its core, capitalizes on the tendency of assets that have performed well recently to continue performing well in the near future, and vice versa. While the previous sections established the behavioral and supply-demand underpinnings of this phenomenon, a practical and programmable momentum strategy requires a deeper understanding of three critical quantitative elements: volume, volatility, and time frame. These factors provide the quantifiable data points necessary to identify, validate, and manage momentum opportunities in real-world markets. They bridge the theoretical why of momentum with the practical what and how for strategy development, forming the foundation upon which robust algorithmic trading systems are built. 1. Volume, the fuel for price movement. Trading code snippet refers to the total number of shares, contracts, or units of a security that have been traded during a specific period. It represents the level of participation and conviction behind a price move. In momentum trading, volume acts as a crucial validator of price action and often provides early signals of trend continuation or potential reversal. What is trading volume? At its simplest, code snippet is a count of transactions. High volume indicates strong market interest and broad participation, suggesting that a price move is robust and sustainable. Conversely, low volume suggests a lack of conviction, making any price movement potent, highly unreliable, or easily reversible. Volume and trend confirmation. For momentum strategy, code snippet is essential for confirming the strength and sustainability of a price trend. Strong trends. A healthy uptrend or downtrend is typically accompanied by high volume in the direction of the trend and lower volume during pullbacks or corrections. For instance, in an uptrend, strong buying on rising prices with high volume indicates genuine demand, while minor pullbacks on low volume suggest that sellers lack conviction. Breakouts. When an asset breaks out a consolidation pattern, e.g., a trading range or triangle, a significant surge in volume accompanying the breakout price action is a strong confirmation signal. It indicates that a large number of participants are entering the market, validating the new trend direction. Without volume confirmation, a breakout might be a fake-out or a temporary move. To illustrate, let's consider how we might load historical price and volume data using Python and code snippet. For practical examples, we'll often use a library like code snippet to fetch real market data. First, ensure you have code snippet and code snippet installed. Download the code on OnePageCode Substack. Now, let's fetch some data and display the first few rows. Download the code on OnePageCode Substack. This initial code snippet sets up our data environment. We download daily historical data for Apple code snippet for specified period. Notice the code snippet column, which is provided directly by code snippet. This column is crucial for our analysis. Next, let's visualize how price and volume typically interact. While we can't show a chart here, we can describe the data's behavior and consider how to calculate simple volume statistics. Download the code on OnePageCode Substack. Here, we compute a 20-day simple moving average, SMA, of volume. This average acts as a baseline to identify unusually high or low volume days. We then create a Boolean column code snippet that flags days where the volume is 1.5 times greater than its 20-day SMA. In a real strategy, a momentum trader would look for such high volume days coinciding with strong price moves, e.g., significant price increase on a code snippet day, as a sign of confirmed momentum. Volume and reversal signals. Volume can also provide early warnings of potential trend reversals. Climax volume, a sharp, often record-breaking spike in volume at the peak of an uptrend or trough of a downtrend can signal exhaustion. For example, a blow-off top sees prices surge on extremely high volume, often followed by a sharp reversal as all available buyers have entered the market. Volume divergence. If an asset makes a new price high, but on significantly lower volume than previous highs, it suggests that the buying conviction is weakening. This divergence between price and volume can be a precursor to a downtrend. Download the code on OnePageCode Substack. This snippet further defines our analysis by creating code snippet and code snippet signals. These combine a significant price change, e.g., greater than 2% increase or less than -2% decrease, with our code snippet. Such conditions are precisely what a quantitative momentum strategy would look for. Strong price movement backed by substantial trading interest. Volume-based indicators. Several technical indicators explicitly incorporate volume to provide deeper insights. Code snippet, a cumulative indicator that adds volume on up days and subtracts it on down days. It aims to show whether smart money is accumulating or distributing an asset. Code snippet measures the amount of money flowing into or out of an asset. It combines price and volume to assess accumulation/distribution pressure. Practical considerations for volume. While high volume is generally desirable for momentum strategies due to confirming trend strength, traders must also consider code snippet. Assets with very low trading volume may be difficult to enter or exit without significantly impacting the price, code snippet, making them unsuitable for strategies requiring quick execution or large position sizes. 2. Volatility, measuring market energy and risk. Code snippet is a measure of the rate and magnitude of price fluctuations of an asset. In simpler terms, it describes how much an asset's price moves up or down over a given period. For momentum traders, volatility is a double-edged sword. It presents opportunities for profit but also introduces significant risk. What is volatility? High volatility means prices are moving rapidly and over a wide range, offering larger potential profits but also larger potential losses. Low volatility implies stable prices and smaller movements. Momentum strategies often thrive in volatile markets, as large price swings create the necessary conditions for trends to develop and sustain. Quantifying volatility. Quantitative traders use specific metrics to measure volatility. Standard deviation of returns. The code snippet of an asset's returns is a common statistical measure of its historical volatility. A higher standard deviation indicates greater price dispersion around the average return, meaning the price tends to fluctuate more widely. Download the code on OnePageCode Substack. In this snippet, we first calculate the code snippet of the asset, which are often preferred for financial time series analysis. Then, we compute the 20-day rolling standard deviation of these returns, effectively giving us a measure of the asset's recent price variability. Multiplying by code snippet annualizes this daily volatility, making it comparable across different assets and time frames. A higher code snippet value indicates a more volatile period. Average True Range, ATR. The code snippet is a volatility indicator developed by J. Wells Wilder Jr. It measures market volatility by calculating the average of true ranges over a specified period. The code snippet for a given day is the greatest of the following. 1. The current high minus the current low. 2. The absolute value of the current high minus the previous day's close. 3. The absolute value of the current low minus the previous day's close. ATR is particularly useful because it accounts for gaps and limit moves, providing a more comprehensive measure of volatility than simple daily ranges. Download the code on OnePageCode Substack. Here, we systematically calculate the code snippet for each day, considering all relevant price movements. Then, we compute the code snippet using an exponential moving average, EMA, over a 14-period window, which is a common setting. ATR is often used to set stop-loss levels, while wider ATR implies a need for a wider stop to avoid being prematurely stopped out by normal market fluctuations. Volatility and momentum strategy. Opportunity. High volatility creates larger price swings, which are exactly what momentum strategies aim to capture. A rapidly moving asset has greater potential for significant gains in a short period. Risk. The double-edged sword aspect comes from the increased risk of larger drawdowns. In highly volatile markets, prices can reverse quickly, leading to substantial losses if positions are not managed effectively. Position sizing. Volatility is a critical input for code snippet. Traders often reduce their position size in highly volatile assets to limit potential losses, or conversely, increase it in less volatile assets where price movements are smaller. This ensures that the dollar risk per trade remains consistent. Volatility-based indicators. Code snippet, composed of a simple moving average and two standard deviation bands above and below it. They expand with increasing volatility and contract with decreasing volatility, helping to identify overbought/oversold conditions and potential breakouts. Code snippet, similar to Bollinger Bands, but use ATR to define the channel width, making them less prone to false signals during extreme price spikes. 3. Time frame, the lens of analysis. The code snippet refers to the period over which price data is aggregated, e.g., 1 minute, 1 hour, daily, weekly, monthly. The choice of time frame significantly impacts how trends are perceived, how frequently signals are generated, and the overall style of a momentum trading strategy. Understanding time frames. Every price chart is a representation of data over a specific time frame. A 15-minute chart shows price movements aggregated every 15 minutes, while a daily chart shows the open, high, low, and close for each trading day. Trend perception. A trend that appears strong on a daily chart might be a mere fluctuation or even a counter trend on a weekly chart. Conversely, a clear trend on a 5-minute chart might be invisible on a daily chart. Signal frequency. Shorter time frames generate more trading signals, but are also more prone to noise and false signals. Longer time frames generate fewer signals, but are generally more rally able and reflect stronger, more sustainable trends. Different time frames and their implications. Momentum traders typically align their chosen time frame with their trading style and risk tolerance. Intraday time frames, e.g., 1 minute, 5 minute, 15 minute, hourly. Trading style, scalping, very short term, multiple trades per day. Day trading, trades opened and closed within the same day. Implications. High frequency of trades, high transaction costs, requires constant monitoring, susceptible to market noise. Momentum strategies on these frames focus on very short-term price bursts. Daily time frame. Trading style, swing trading, holding positions for a few days to several weeks, short-term position trading. Implications. Balance between signal frequency and reliability, less susceptible to intraday noise, allows for more relaxed monitoring. This is a very common time frame for quantitative momentum strategies. Longer time frames, e.g., weekly, monthly. Trading style, position trading, holding for weeks to months, long-term investing. Implications. Captures major trends, very few signals, low transaction costs, requires significant patience, less sensitive to short-term news. Momentum strategies here focus on multi-month or multi-year trends. Impact on indicators and strategy. The time frame directly influences the calculation and interpretation of technical indicators. A 20-period moving average on a 1-hour chart averages the last 20 hours of price data, W. While on a daily chart, it averages the last 20 days. These will produce vastly different lines and signals. Volatility measures like ATR will also differ significantly. A daily ATR might be much larger than an hourly ATR, reflecting the larger price ranges over a longer period. Quantitative strategies often involve code snippet data to different time frames to analyze trends from multiple perspectives, a technique known as code snippet. Let's demonstrate how to resample daily data into weekly data using code snippet. Download the code on OnePageCode Substack. Here, we take our code snippet and use the code snippet method to convert it into weekly data. For prices, we use code snippet to get the open, high, low, and close for the week. For code snippet, we code snippet the daily volumes to get the total weekly volume. This allows a quantitative trader to analyze the same asset through different temporal lenses, identifying both short-term tactical opportunities and long-term strategic trends. Download the code on OnePageCode Substack. This final code chunk demonstrates how indicators are calculated differently on the resampled weekly data. We compute a 10-period SMA and an annualized volatility measure based on weekly returns. Notice the change in the annualization factor to code snippet for weekly data. This highlights how strategy logic and parameter tuning must adapt to the chosen time frame. A momentum strategy might look for a strong weekly trend, e.g., price above C, odd snippet, and then use daily or hourly charts for precise entry and exit points. Practical considerations for time frame. The selection of a time frame is a deeply personal choice influenced by a trader's personality, available capital, and time commitment. A quantitative trader must carefully consider noise versus signal. Shorter time frames have more noise. Longer time frames filter out noise but react slower. Transaction costs. More frequent trading on shorter time frames incurs higher cumulative transaction costs, commissions, slippage. Holding period. The time frame dictates the typical holding period of trades. 4. Confluence. Synthesizing volume, volatility, and time frame. The true power of these three elements emerges when they are considered in code snippet, meaning they are assessed together to confirm or invalidate a trading signal. An expert quant trader doesn't just look for high volume, high volatility, or a specific time frame in isolation. They look for how these factors interact to paint a comprehensive picture of market dynamics. For example, a robust momentum signal might be characterized by high volume, a significant price breakout from a consolidation pattern confirmed by a surge in trading volume, indicating strong institutional participation. Medium to high volatility, the asset exhibiting sufficient recent price swings, as measured by ATR or standard deviation, to offer attractive profit potential, but not so extreme that it suggests errati. C. Unmanageable price action. Appropriate time frame. The breakout and volume confirmation occurring on the primary trading time frame, e.g., daily chart for a swing trader, potentially supported by a longer time frame trend, e.g., weekly chart showing a sustained uptrend, and refined by a shorter time frame for precise entry, e.g., 1-hour chart. This integrated approach allows quantitative traders to develop sophisticated rules. For instance, a rule might be initiate a long position when the daily closing price breaks above its 50-day moving average, provided that the daily volume is at least 1.5 times its 20-day average, and the 14-period ATR is above its 100-period average, confirming increased volatility, while the weekly trend remains positive. Understanding volume, volatility, and time frame is not merely conceptual. It is the essential groundwork for translating theoretical momentum principles into actionable, quantifiable, and ultimately profitable trading strategies. These elements form the measurable inputs that drive the logic of any robust algorithmic trading system. Contrasting with the trend-following strategy. Understanding the fundamental distinctions between momentum trading and trend-following strategies is crucial for any quantitative trader. While both aim to profit from price movements, their underlying mechanisms, data analysis approaches, and signal generation methods differ significantly. The key lies in differentiating between cross-sectional/relative momentum and time series/absolute momentum. Momentum trading, cross-sectional, and relative momentum. Momentum trading, as discussed in previous sections, is primarily a cross-sectional strategy. This means it involves analyzing and comparing multiple assets, e.g., stocks, sectors, cryptocurrencies, at a single point in time or over the same recent historical period. The goal is to identify assets that have performed relatively better than their peers. The concept of relative momentum is central here. Instead of judging an asset's performance in isolation, its strength is assessed in comparison to other assets within a defined universe. For instance, a momentum trader might rank all stocks in the S&P 500 based on their performance over the last 6 months and then select the top 10% or 20% for investment, irrespective of whether the overall market is trending up or down. The assumption is that these outperforming assets will continue to outperform in the short to medium term. Practical application. Imagine a scenario where the market is generally flat, but a few technology STO CKs are surging due to positive earnings reports. A momentum trader would identify these specific tech stocks as leaders based on their relative strength compared to other stocks, even if the broader market isn't showing a clear upward trend. The focus is on identifying winners from a pool of candidates. Data requirements. Implementing cross-sectional momentum requires access to performance data, e.g., returns, for a large universe of assets over the same look-back period. At any given decision point, you need a snapshot of how all these assets have performed relative to each other. To illustrate the cross-sectional relative momentum approach, let's consider a simplified example where we identify top-performing assets from a hypothetical universe. Download the code on one patch code Substack. This initial code block imports necessary libraries and sets up the basic parameters for our hypothetical data. We're preparing to simulate returns for a collection of assets. Download the code on one patch code Substack. Here, we simulate this snapshot of returns across multiple assets at a single point in time. This code snippet series represents the cross-sectional data that a momentum trader would analyze. Notice how each asset has its own return value, and our goal is to compare them. Download the code on one patch code Substack. This step explicitly demonstrates the relative aspect. We're not checking if an asset's return is positive, but rather how it compares to the returns of their assets. Sorting them allows us to easily identify the top performers relative to the entire group. Download the code on one patch code Substack. Finally, we apply a simple momentum strategy, selecting the top code snippet assets. This clearly shows how a momentum strategy operates by picking the strongest assets from a comparative pool, irrespective of the overall market direction. Trend following, time series, and absolute momentum. In contrast, trend following strategies are predominantly time series based. This means they focus on analyzing the historical price and volume data of a single asset over time to identify and capitalize on its sustained directional movement, an upward or downward trend. The concept of absolute momentum, or sometimes referred to as price momentum in this context, is key here. An asset's performance is judged against its own past performance or against a fixed threshold, rather than against other assets. For example, a trend-following strategy might buy a stock if its 50-day moving average crosses above its 200-day moving average, signaling an upward trend in that specific stock. The decision is made solely on the behavior of that one stock. Practical application. Consider a stock that has been steadily increasing in price for several months. A trend follower would identify this sustained upward movement using indicators like moving averages or breakout levels and initiate a long position. The strategy isn't concerned with how this stock performs relative to other stocks, but rather with its own consistent upward trajectory. If the stock reverses course, the trend follower would exit the position. Data requirements. Implementing time series trend following requires extensive historical price and volume data for each individual asset being tracked. For each asset, you need a complete history to calculate indicators like moving averages, Bollinger Bands, or MACD. To illustrate the time series absolute momentum approach, let's look at a classic trend following example, the moving average crossover. Download the code on one patch code Substack. This first part sets up our time series data for a single hypothetical stock. This is the raw material for trend following analysis, where the sequence and evolution of prices over time are critical. Download the code on one patch code Substack. Here, we calculate two common time series indicators, the simple moving average, SMA, and long moving average, LMA. These are derived solely from the stock's own historical price data, exemplifying the absolute nature of trend following analysis. Download the code on one patch code Substack. This final step generates trading signals based on the moving average crossover. A positive code snippet value indicates a potential buy signal, SMA crossing above LMA, while a negative value indicates a sell signal, SMA crossing below LMA. This decision is purely based on the historical trend of this specific stock, demonstrating the time series. IES, absolute momentum approach. Comparative summary of key differences. The distinctions between momentum trading and trend following strategies are fundamental and impact everything from data requirements to typical market environments in which they perform best. Criteria: momentum trading, cross-sectional/relative, trend following, time series / absolute. Data-focused snapshot of performance across many assets. Historical performance of a single asset over time. Comparison type relative. Asset versus other assets. Absolute. Asset versus its own past performance / threshold. Underlying assumption: outperformers continue to outperform peers. Trends, once established, tend to persist. Primary goal: identify leading assets within a universe. Capture sustained, directional price movements. Typical indicators: ranked returns, e.g., 6-month total return, relative strength index, RSI, used comparatively. Moving averages: SMA, EMA, MACD, ADX, Bollinger Bands, breakouts. Time horizon: typically short to medium term, weeks to months. Often rebalanced frequently. Can range from medium to long term, months to years, aiming to ride significant trends. Market environment: often thrives in differentiated markets where some sectors / assets are strong while others are weak. Performs best in strongly trending markets, up or down. Struggles in choppy / sideways markets. Risk profile: hint, may involve higher portfolio turnover. Sensitive to shifts in relative leadership. Can experience drawdowns during trend reversals. Susceptible to whipsaws in non-trending markets. Data requirements: clean, synchronized return data for a broad universe of assets at specific points in time. Clean, continuous historical price and volume data for individual assets. Impact on technical indicators and statistical methods. The distinction between cross-sectional and time series analysis profoundly influences the choice of technical indicators and statistical methods. Cross-sectional, momentum trading. Indicators. Focus on metrics that allow for direct comparison. Simple total returns over a look-back period, e.g., 3-month, 6-month, are common. Relative strength, RS, often refers to an asset's performance divided by a benchmark or another asset. Statistical methods like z-scores or percentiles applied to returns across the universe help normalize and rank performance. Statistical methods: ranking, percentile analysis, cross-sectional regressions, though less common for basic momentum. Portfolio optimization based on relative strength. Example: calculating the 12-month return for every stock in the S&P 500 and then buying the top decile. Time series, trend following. Indicators: emphasize identifying trends or changes within a single asset's price data. Moving averages: smooth price data to reveal underlying trends. MACD, moving average convergence divergence, measures the relationship between two moving averages. ADX, average directional index, quantifies trend strength. Breakout indicators identify when prices move beyond recent highs / lows. Statistical methods: time series analysis, e.g., ARIMA, GRCH models for more advanced applications. Statistical tests for autocorrelation, signal processing techniques. Example: buying a stock when its 50-day moving average crosses above its 200-day moving average. Practical implications and programming logic. The conceptual differences translate directly into distinct programming logic and data structures. For momentum trading, cross-sectional your code will often involve iterating through a list of assets, calculating a performance metric for each, and then sorting or filtering these assets based on their relative performance. Data will likely be stored in a data frame where rows represent assets and columns represent performance metrics at a specific point, or a series of such data frames over time. Hint for implementation: think about functions that take a snapshot of market data and return a ranked list of assets. For trend following, time series your code will typically involve iterating through the historical data of one asset at a time, applying functions that calculate indicators, e.g., code snippet, and then generating signals based on thresholds or crossovers within that single A. Sets history. Data will usually be structured as a time series data frame for each asset, with dates as the index and price / volume columns. Hint for implementation: Think about functions that take a single asset's historical price series and return a series of buy-sell signals. Understanding these core distinctions is paramount for designing robust trading systems. While both strategies aim to capture market movements, they do so through fundamentally different lenses, requiring distinct analytical tools and computational approaches. Look-back windows in trend-following strategies. In previous sections, we touched upon trend-following strategies, often relying on moving averages. The concept of a look-back window is fundamental to these strategies, defining the period over which an average or other indicator is calculated. Defining trend-following signals with look-back windows. For trend following, look-back windows are typically applied to a single asset's price series over time. A common approach involves comparing two moving averages, one calculated over a shorter look-back period and another over a longer period. Consider the simple moving average, SMA. A 50-day SMA uses a 50-day look-back window, averaging the closing prices of the past 50 trading days. A 200-day SMA uses a 200-day look-back window. Download the code on OnePageCode Substack. This initial code block sets up a code snippet with hypothetical daily closing prices for a single asset. This structured data is essential for applying time series calculations like moving averages. Download the code on OnePageCode Substack. Here, we apply the code snippet method to calculate the SMAs. The code snippet parameter directly corresponds to our look-back period. Notice how code snippet is used to show rows where both SMAs have been fully calculated, as the initial data points for a rolling window will be code snippet until enough data is available. Detecting crossovers for trading signals. A common signal in trend following is a crossover. For instance, a buy signal might be generated when the shorter-term SMA crosses above the longer-term SMA, indicating an upward trend. Conversely, a sell signal might occur when the shorter-term SMA crosses below the longer-term SMA. Download the code on OnePageCode Substack. In this segment, we create a code snippet column. We use code snippet to assign code snippet by when the short SMA is above the long SMA and code snippet otherwise. The code snippet column then identifies the exact points where a crossover occurs by looking for changes in the code snippet using code snippet. A value of code snippet in code snippet indicates a buy signal, and code snippet indicates a sell signal. This programmatic detection is crucial for automating trading decisions. Look-back windows in momentum trading. While trend following uses look-back windows to analyze a single asset's price over time, momentum trading employs look-back windows in a fundamentally different way to assess relative performance across a universe of assets. This is known as cross-sectional analysis. Cross-sectional analysis for relative performance. In momentum strategies, the look-back window defines the period over which we measure each asset's historical return. The goal is to identify which assets have performed best or worst relative to others within that specific look-back period. For example, a common look-back window for momentum is 12 months, excluding the most recent month to avoid short-term reversals. You would calculate the total return for every asset in our universe over this 12-month period. Calculating historical returns within the look-back window. The historical average return mentioned in the analysis is typically the total return over the specified look-back period. This can be calculated using simple returns or logarithmic returns. For multi-period returns, simple returns are often preferred for their direct interpretability as total percentage change. Let's simulate data for multiple assets to demonstrate this. Download the code on OnePageCode Substack. This code creates a code snippet where each column represents a different asset's price series. This structure is ideal for performing cross-sectional analysis, where we compare performance across columns at a given point in time. Download the code on OnePageCode Substack. Here, we define a helper function code snippet to compute the simple return over a given number of days. We then apply it to a single asset's price series for a specific look-back period to illustrate how a single momentum value is derived. The rolling look-back window in momentum. Unlike trend following where calculations are often continuous for a single asset, in momentum, The look-back window rolls forward in time to identify new sets of top and bottom performers at specific rebalancing points. At each rebalancing date, e.g. monthly, 1. Define the look-back window, e.g. past 12 months. 2. For every asset in the universe, calculate ITS total return over that look-back window. 3. Rank all assets based on these returns. 4. Select assets for the long and short portfolios. This process is then repeated at the next rebalancing date, with the look-back window having advanced. Download the code on one patch code Substack. This snippet demonstrates the core of the rolling look-back process for momentum. At a specific code snippet, we take all available price data up to that point. Then, for each asset, we calculate its momentum score over the defined code snippet. This generates a snapshot of all assets' relative performance at that particular rebalancing point. Cross-sectional ranking and portfolio construction. Once momentum scores are calculated for all assets at a given rebalancing point, the next step is to rank them. This ranking is the essence of cross-sectional analysis in momentum trading, comparing assets against each other at the same point in time. The specific metric used for relative performance is typically the total return over the look-back period. While risk-adjusted returns, like Sharpe ratio or annualized returns, can also be used, simple total return is the most common and intuitive for pure momentum strategies. Identifying top and bottom performers. After ranking, we select a predefined proportion of the top-performing assets to go long, buy, and a predefined proportion of the bottom-performing assets to go short, sell. This forms a long/short portfolio. For example, if we have 100 assets in our universe, we might decide to go long the top 20%, 20 assets, and short the bottom 20%, 20 assets. Download the code on one patch code Substack. Here, we simply sort the code snippet in descending order to identify the best performers at the top. This sorted list is the output of our cross-sectional analysis. Download the code on one patch code Substack. This code block demonstrates how to select the specific assets for the long and short legs of the portfolio. Code snippet and code snippet are convenient code snippet methods for this. In a real strategy, code snippet would be a larger integer or a percentage of the total universe. The difference in performance between these two groups, top versus bottom, is what the momentum strategy aims to capture. The role of the look-ahead window, holding period. Once the long and short assets are selected based on their past momentum, via the look-back window, the look-ahead window defines the period during which these positions are held. This is also known as the holding period. For instance, if we rebalance monthly, our look-ahead window is 1 month. The selected assets are held for that month, and then at the end of the month, the entire process, look-back calculation, ranking, selection, is repeated. Download the code on one patch code Substack. This simple demonstration shows how the code snippet from code snippet can be used to determine the code snippet based on the chosen code snippet. This is crucial for managing the strateg. Wise life cycle and turnover. The look-ahead window is critical because it defines how long we expect the observed momentum to persist. If the look-ahead window is too short, transaction costs may eat into profits. If it's too long, the momentum effect might reverse, leading to losses. Tying it together, a high-level momentum strategy algorithm. Let's outline the full process for a momentum strategy, integrating the concepts of look-back, cross-sectional analysis, and look-ahead. Download the code on one patch code Substack. This comprehensive function code snippet encapsulates the entire process. It iterates through potential rebalancing dates, and at each date, it performs the look-back calculation, cross-sectional ranking, and long/short asset selection. The code snippet parameter for code snippet is a simplification. In a real-world scenario, you'd iterate over actual trading days or specific monthly/quarterly rebalance dates. This structure provides a blueprint for building a full backtesting system. Practical considerations. Impact of window sizes. The choice of look-back and look-ahead window sizes significantly impacts a momentum strategy's performance, risk, and turnover. Look-back window. Short windows, e.g., 1 to 3 months, capture short-term momentum, but can be more susceptible to noise and quick reversals. They often lead to higher turnover and transaction costs. Such strategies might be sensitive to inflection points, where short-term trends reverse, requiring swift exit. Its strategies. Medium windows, e.g., 6 to 12 months, common for classical momentum strategies. They aim to capture more persistent trends, offering a balance between responsiveness and stability. Less prone to noise than very short windows. Long windows, e.g., greater than 12 months, may be too slow to react to changing market conditions and can suffer from value effects, where previously outperforming assets become expensive and underperform. Look-ahead window, holding period. Short holding periods, e.g., 1 month, lead to high turnover, increasing transaction costs. However, they allow the strategy to adapt quickly to new momentum signals. Medium holding periods, e.g., 3 to 6 months, a common compromise, reducing turnover while still allowing the strategy to capture momentum. Long holding periods, e.g., 6 months, significantly reduce transaction costs, but risk holding positions that have lost their momentum or even reversed. The optimal window sizes are typically determined through rigorous backtesting and depend on the asset class, market conditions, and the specific definition of momentum being used. There is no one-size-fits-all answer, and a robust strategy often involves testing various combinations. For example, tech stocks might exhibit faster momentum cycles, favoring shorter look-back/look-ahead windows, while commodities or broader market indices might show more persistent trends over longer periods. The key is to understand that these windows are not static, but are critical parameters to be optimized and monitored. More on trend following. Trend following is a robust trading strategy designed to capitalize on sustained price movements in a particular direction. Unlike momentum strategies that often focus on relative strength or short-term price acceleration, trend following is inherently a time series-based approach. It operates on the principle of absolute momentum, meaning it evaluates the momentum of a single asset against its own historical performance, rather than comparing it to other assets or a benchmark. The core objective is to identify and ride trends, holding positions for as long as the trend persists and exiting when it shows signs of reversal. Dual moving averages for signal generation. The cornerstone of many trend-following systems is the use of dual moving averages. This method involves calculating 2 moving averages, one with a shorter look-back period and one with a longer look-back period, and then generating trading signals based on their crossovers. Types of moving averages. Before diving into crossovers, it's crucial to understand the most common types of moving averages. 1. Simple moving average. SMA. The SMA is the most basic form of moving average. It calculates the average price of an asset over a specified number of periods. Each price point within a look-back window is given equal weight. Calculation. Sum the closing prices over the look-back period and divide by the number of periods. Pros. Simple to understand and calculate. Provides a smooth representation of price action. Cons. Prone to lag, as it gives equal weight to old and new data. A sudden price spike or drop at the beginning of the look-back window will have the same impact as one at the end, leading to a delayed reaction to recent price changes. 2. Exponential moving average. EMA. The EMA is a more sophisticated moving average that gives more weight to recent price data, making it more responsive to new information than the SMA. Calculation. EMA calculation involves a smoothing factor that gives exponentially decreasing weights to older observations. The formula is code snippet, where code snippet. Pros. Reduces lag compared to SMA, reacting more quickly to price changes. This can be beneficial in volatile markets where rapid shifts occur. Cons. While more responsive, it still exhibits lag. Its responsiveness can also lead to more false signals in choppy markets. Choosing between SMA and EMA. The choice often depends on the trader's preference for responsiveness versus smoothness. For strategies requiring faster signals, EMA is often preferred. For strategies that prioritize filtering out noise and confirming longer-term trends, SMA might be chosen, or EMAs with longer periods. Many traders experiment with both to see which performs better for their specific asset and time frame. Common look-back periods. The short and long periods for moving averages are critical parameters. There's no single best combination, as optimal periods can vary dependent on the asset, market conditions, and the trader's time horizon. However, some commonly used combinations include short-term, e.g., 10, 20, 50 days. These are often used as the fast-moving average. A 20-day MA might represent a typical trading month, while a 50-day MA could indicate a short to medium-term trend. Long-term, e.g., 50, 100, 200 days. These serve as the slow-moving average, indicating the underlying, more significant trend. The 200-day MA is a widely observed benchmark for the long-term health of an asset or market. Typical combinations: 20-day SMA/EMA and 50-day SMA/EMA. Popular for swing trading and identifying medium-term trends. 50-day SMA/EMA and 200-day SMA/EMA. A classic combination for identifying major long-term trends and for position trading. The Golden Cross, 50-day MA crossing above 200-day MA, and Death Cross, 50-day MA crossing below 200-day MA, are widely followed signals based on this pairing. The crossover signal. The essence of dual moving average trend following lies in the crossover. Bullish crossover by the signal occurs when the shorter period moving average crosses above the longer period moving average. This indicates that recent prices are, on average, higher than older prices, suggesting an upward trend is strengthening or beginning. Bearish crossover. Sell signal occurs when the shorter period moving average crosses below the longer period moving average. This suggests that recent prices are, on average, lower than older prices, indicating a downward trend is strengthening or beginning, or an upward trend is reversing. The inherent lag of moving averages. Despite their utility, all moving averages suffer from lag. They are inherently backward-looking indicators, as they are calculated based on past prices. This means delayed signals. Crossover signals will always occur after the actual price reversal has begun. The longer the look-back periods, the greater the lag. Missed early moves. By the time a robust trend signal is generated, a significant portion of the price move might have already occurred. Trade-off. This lag is the trade-off for smoothing out price noise. Shorter MAs are more responsive but can generate more false signals. Longer MAs are smoother but more delayed. Understanding this lag is crucial for managing expectations and risk in trend-following strategies. Addressing pitfalls, false signals, and whipsaws. While powerful in trending markets, moving average crossovers are susceptible to significant pitfalls, particularly in ranging or choppy markets. False signals. In the absence of a clear trend, prices tend to oscillate around a mean. During such periods, the short and long moving averages will frequently cross back and forth, generating numerous buy and sell signals that do not lead to sustained price moves. Whipsaws. These frequent, rapid crossovers are known as whipsaws. Each whipsaw typically results in a small loss as a position is opened and then quickly closed when the trend fails to materialize or immediately reverses. A series of whipsaws can quickly erode capital, making ranging markets particularly challenging for pure trend-following strategies. Mitigation strategies. Conceptual to combat false signals and whipsaws, traders often employ additional filters or techniques. Volatility filters. Requiring a certain level of volatility, e.g., using average true range, ATR, before acting on a signal. Low volatility often indicates ranging markets. Trend strength indicators. Using indicators like the average directional index, ADX, to confirm the presence of a strong trend. Only taking signals when ADX is above a certain threshold, e.g., 20 or 25. Price confirmation. waiting for price to move a certain percentage or close above/below the crossover point for confirmation. Wider moving average spreads. Using longer look-back periods for both MAs can reduce whipsaws, but the cost of increased lag. Selecting optimal look-back windows. The question of optimal look-back windows is central to successful trend following. There is no universal best combination that works for all assets, time frames, or market conditions. What works for a highly liquid stock might not work for a commodity, and what's effective in a bull market might fail in a bear market. Conceptual backtesting and optimization. The selection of moving average periods is often an iterative process involving backtesting. Backtesting defined, backtest. Ting is the process of testing a trading strategy using historical data to determine its profitability and risk. For moving averages, this means simulating trades based on the generated signals over past market data. Parameter optimization. This involves systematically trying different combinations of short and long moving average periods, e.g., testing all combinations from 10-day to 100-day for the short MA and 50-day to 250-day for the long MA. The goal is to find the combination that yields the best performance metrics, e.g., highest profit, lowest drawdown, best risk-adjusted returns over the historical period. Avoiding overfitting. A critical pitfall in optimization is overfitting. This occurs when a strategy's parameters are tuned too precisely to past data, performing exceptionally well historically but failing in live trading because they capture noise rather than underlying market dynamics. To mitigate overfitting, techniques like walk-forward optimization, optimizing on a segment of data and testing on the next unseen segment, and using out-of-sample data not used in the optimization process, are employed. Practical example: trend following with dual moving averages. Let's walk through a practical example using Python to calculate moving averages, generate signals, and visualize them. We'll use hypothetical historical data for a stock. First, we need to set up our environment and fetch some historical stock data. We'll use the code snippet library for data retrieval and code snippet for data manipulation. Download the code on OnePageCode Substack. This initial code block sets up our environment by importing necessary libraries. We then specify a stock ticker, code snippet, and a date range. The code snippet function fetches historical closing prices. A fallback to dummy data is included to ensure the example can run even if the code snippet download encounters issues, making the code robust for demonstration. Next, we'll calculate two simple moving averages, SMAs, a short 50-day SMA, and a long 200-day SMA. Download the code on OnePageCode Substack. Here, we define our look-back periods for the short and long SMAs. The code snippet method from Pandas is highly efficient for calculating rolling statistics like moving averages. We apply it to the close price column and then compute the mean for each window, storing the results in new columns code snippet and code snippet. Note that the initial rows for these columns will be code snippet until enough data points are available to fill the window. Now, let's calculate exponential moving averages, EMAs, for comparison. EMAs are often preferred for their responsiveness. Download the code on OnePageCode Substack. This chunk demonstrates how to calculate EMAs using Pandas code snippet method. The code snippet parameter is used to define the period, and code snippet ensures a consistent calculation method often used in financial applications. We create code snippet and co. The snippet columns, which will be more reactive to recent price changes than their SMA counterparts. The core of the trend following strategy is identifying the crossover signals. We'll generate signals based on the SMA crossovers first. Download the code on OnePageCode Substack. This segment is crucial for signal generation. We first initialize a code snippet column. Then we assign code snippet by when the short SMA is above the long SMA, and code snippet sell when it's below. The code snippet column is derived by taking the code snippet of code snippet. A code snippet in code snippet means a new buy signal, crossing from below to above, and a code snippet means a new sell signal, crossing from above to below. Other non-zero values in code snippet would indicate position changes within a trend, but we are primarily interested in the initial crossovers. To make the signals actionable for visualization, we'll refine code snippet to mark specific entry and exit points. Download the code on OnePageCode Substack. This refined signal generation focuses on the exact point of crossover rather than the continuous state. We use code snippet to compare the current day's MA positions with the previous days. If the short MA was below the long MA yesterday and is above it today, that's a buy signal. Conversely, if it was above yesterday and is below today, that's a sell signal. These specific points are crucial for identifying trade entry/exit. Finally, we'll visualize the P, RICE, moving averages, and the generated signals on a chart. Download the code on OnePageCode Substack. This visualization code uses code snippet to plot the stock's closing price, the short and long SMAs, and marks the buy and sell signals directly on the chart. Green upward triangles indicate bullish crossovers, buy signals, while red downward triangles indicate bearish crossovers, sell signals. This visual representation is invaluable for understanding how the strategy would have performed historically and for observing the lag and potential whipsaws. Hypothetical step-by-step trend-following trade example. Let's consider a hypothetical scenario for a single stock applying the 50/200-day SMA crossover strategy. Scenario: you are tracking stock XYZ and you've decided to implement a 50/200-day SMA trend-following strategy. 1. Initial state: no position stock XYZ has been in a downtrend, and its 50-day SMA is well below its 200-day SMA. You hold no shares. 2. Signal generation: bullish crossover. Date: June 15, 2023. Observation: stock XYZ has started to recover. On this day, the 50-day SMA closes above the 200-day SMA for the first time in months. Action: this is your buy signal. You decide to enter a long position. Trade: you buy 100 shares of stock XYZ at its closing price of $150. Your initial capital deployed is $15,000. 3. Position management, trend continuation. For the next several months, the 50-day SMA remains above the 200-day SMA. Stock XYZ Connie. News to trend upwards, reaching $180, then $200. You hold your position, ignoring minor price fluctuations as the core trend signal remains bullish. This illustrates the set and forget aspect of pure trend following, reducing emotional trading. 4. Signal generation, bearish crossover. Date: December 10, 2023. Observation: stock XYZ has peaked around $210 and started to pull back. On this day, the 50-day SMA closes below the 200-day SMA. Action: this is your sell signal. You decide to exit your long position. Trade: you sell your 100 shares of stock XYZ at its closing price of $195. 5. Outcome: buy price, $150 per share. Sell price, $195 per share. Gross profit per share, $195 to $150 equals $45. Total gross profit, $45. 100 shares equals $4,500 before commissions/slippage. This example highlights how the strategy aims to capture the bulk of a major trend. It also implicitly shows the lag. The peak was $210, but the sell signal only came at $195, indicating the inherent delay of moving averages. In a real scenario, commissions, slippage, the difference between expected and actual execution price, and potential reentry signals would also be considered. Implementing the momentum trading strategy. Transitioning from the theoretical framework of momentum trading to its practical application requires a structured approach. This section lays the groundwork for building a robust momentum strategy, beginning with the definition of the trading universe and the conceptualization of the long/short portfolio construction. Defining the trading universe. The first critical step in implementing any quantitative trading strategy is to define the code snippet, the specific set of assets that the strategy will consider for trading. This decision is fundamental as it impacts data requirements, computational complexity, and the potential for diversification and profitability. For our initial implementation, we will focus on the constituents of the code snippet. The DJIA is a price-weighted index that tracks 30 large, publicly owned companies trading on the New York Stock Exchange, NYSE, and NASDAQ. Its selection offers several advantages for a beginner-level strategy. Manageability. With only 30 components, it's a relatively small and manageable universe for initial data acquisition and processing. Liquidity. DJIA stocks are generally large cap and highly liquid, reducing concerns about slippage and execution costs for basic backtesting. Representativeness. While not as broad as the S/P 500, it represents a significant portion of the U.S. industrial economy. While the DJIA serves as an excellent starting point, in more advanced scenario, OS, a trading universe, might be expanded to include S/P 500 constituents, a broader representation of large-cap U.S. equities. Russell 2000 constituents, to target small-cap stocks. Specific sectors, to implement sector-specific momentum strategies. Global indices, for international diversification. Commodities, currencies, or fixed income, to diversify across asset classes. Acquiring ticker symbols for the universe. To work with the DJIA components programmatically, we first need their ticker symbols. While these can be found on various financial websites, for a reproducible and clear example, we can initially define them as a Python list. In a real-world application, these lists might be dynamically sourced from a database or API to ensure they are always up to date with index rebalances. Let's start by defining a subset of DJIA ticker symbols for our initial demonstration. For practical implementation, you would typically use the full list. Download the code on OnePageCode Substack. This initial code chunk simply creates a Python list containing the stock ticker symbols that constitute our defined trading universe. This list will be used to fetch historical price data for each asset. The core, relative momentum, and long/short portfolio construction. The essence of a relative momentum strategy lies in identifying assets that have recently code snippet the market or their peers and going code snippet, buying them, while simultaneously identifying assets that have code snippet and going code snippet, selling borrowed shares them. This code snippet approach aims to profit from both rising and falling asset prices, and it can also help to hedge market risk to some extent. Quantifying outperformance and underperformance. A key missing piece from a purely conceptual understanding is how outperformance and underperformance are quantitatively defined. This is where the concept of a code snippet becomes crucial. We measure performance over a specific historical period, the look-back window. For a momentum strategy, this typically involves calculating the code snippet of each asset over this window. For example, if we choose a 12-month look-back window, we would calculate the return of each DJIA stock over the past 12 months. The stocks with the highest returns would be considered outperformers, and those with the lowest or negative returns would be underperformers. Common look-back periods for momentum strategies often include 3-month momentum, 6-month momentum, 12-month momentum, often excluding the most recent month to avoid short-term reversal effects, known as 11-month momentum. Criteria for selecting top and bottom performers. Once we have calculated the performance, e.g., cumulative returns, for all assets in our trading universe over the chosen look-back period, we need a method to select our long and short candidates. Common criteria include top N/bottom N. Select the top N assets, e.g., top 5, for the long portfolio and the bottom N assets, e.g., bottom 5, for the short portfolio. Percentile-based. Select assets above a certain percentile, e.g., top 20%, for long and below a certain percentile, e.g., bottom 20%, for short. Fixed threshold. Long assets whose performance exceeds a certain absolute threshold, e.g., 10% return, and short those below another threshold, e.g., minus 5% return. For our initial implementation, we will likely use a simple top-in/bottom approach, as it's straightforward to understand and implement. The exact number of assets for the long and short legs will be a parameter to optimize during backtesting. Initial data acquisition. To calculate historical returns, we need historical price data for each of our selected DJIA tickers. A common and convenient way to access free historical market data is through Python libraries like CodeSnippet or CodeSnippet. CodeSnippet is particularly popular for its ease of use and direct access to Yahoo Finance data. First, ensure you have the CodeSnippet library installed, CodeSnippet. Download the code on OnePageCode Substack. This initial import statement makes the CodeSnippet library available for use, aliasing it as CodeSnippet for convenience. We also import CodeSnippet, which will be crucial for handling the data we retrieve. Next, we'll define a function to encapsulate the data fetching process. This promotes modularity and reusability. For practical backtest, you would typically fetch data over a multi-year period. Download the code on OnePageCode Substack. This function, CodeSnippet, takes a list of tickers and a date range, then uses CodeSnippet to retrieve the daily historical data. It specifically extracts the CodeSnippet adjusted close price, which is crucial for accurate return calculations as it accounts for splits and dividends. The function then cleans the data by dropping any rows with missing values, ensuring a clean dataset for subsequent calculations. Let's put this function to use with our CodeSnippet and fetch data for a recent period. Download the code on OnePageCode Substack. This code block demonstrates how to call our CodeSnippet function with a specified start and end date. It then prints the first few rows and the dimensions of the resulting code snippet, allowing us to quickly inspect the structure and content of the fetch data. Each column represents a stock ticker, and each row corresponds to a trading day, with the values being the adjusted close prices. This code snippet data frame is the raw material from which we will calculate momentum, linking look-back windows to performance measurement. The code snippet is not just a conceptual term. It directly translates into the number of historical periods, e.g., trading days, weeks, or months, over which we calculate returns to assess momentum. For instance, a 252-day look-back window would correspond to approximately 1 trading year, as there are typically 252 trading days in a year. In the next steps, we will use this code snippet data frame to compute the code snippet for each stock. This will involve 1. Calculating daily returns from the adjusted close prices. 2. Aggregating these daily returns over the specified look-back window, e.g., 252 days, to get the cumulative return for that period. 3. Repeating this process for each stock in the universe, for each trading day, to create a time series of momentum scores. This systematic process of data acquisition and the quantitative definition of performance over a look-back window are the foundational steps for truly implementing a momentum trading strategy. Obtaining stock symbols for trading strategies. This section focuses on the critical first step in building a quantitative trading strategy, acquiring the necessary financial instrument identifiers. For our momentum trading strategy, we need a list of stock ticker symbols for the constituents of a major index, such as the Dow Jones Industrial Average, DJIA. While dedicated financial APIs are often the most robust solution for production systems, understanding web scraping techniques is invaluable for data exploration, quick prototyping, and accessing publicly available information. The role of web scraping in data acquisition. Quantitative trading relies heavily on high-quality, reliable data. Before we can analyze historical prices or calculate momentum, we need to know which assets to track. For widely recognized indices like the DJIA, their constituent lists are often publicly available on websites like Wikipedia. Web scraping allows us to programmatically extract this information, automating a process that would otherwise be manual and error-prone. However, web scraping comes with important considerations. Fragility. Website layouts can change without notice, breaking your scraping code. Websites are designed for human consumption, not programmatic extraction. Minor design updates can cause your selectors to fail. Legality and ethics. Always check a website's code snippet file, e.g., code snippet, and terms of service before scraping. The code snippet file is a standard that websites use to communicate with web crawlers and other automated agents, indicating which parts of the site should not be accessed. Some sites explicitly forbid scraping or limit the rate of requests. Excessive scraping can be considered a denial of service attack. For production systems, dedicated APIs are almost always preferred due to their stability, explicit permissions for data access, and often higher data quality. Alternatives for consistent large-scale financial data consider subscribing to professional data vendors, e.g., Bloomberg, Refinitiv, Quandl, or utilizing free/freemium APIs, e.g., AlphaVantage, Polygon.io, Yahoo Finance APIs via libraries like CodeSnippet. These sources are designed for programmatic access and offer greater reliability and often more comprehensive data. For our educational purpose, scraping Wikipedia provides a practical, hands-on example of programmatic data collection, illustrating the underlying principles of interacting with web content. Setting up our environment, required libraries. Before we dive into the code, we need to import the necessary Python libraries. Each library serves a specific purpose in our data acquisition pipeline. Download the code on OnePageCode Substack. Code Snippet. This library simplifies sending HTTP requests. We'll use it to fetch the HTML content of the Wikipedia page. It handles connections, sessions, and various HTTP methods. Code Snippet. Imported as Code Snippet, a powerful library for parsing HTML and XML documents. It creates a parse tree from the page source, allowing us to navigate and search for specific elements using Pythonic methods. Code Snippet, the cornerstone of data manipulation in Python. We'll use it to convert the scraped HTML table into a structured code snippet, making it easy to clean and extract specific columns. Code Snippet. While not directly called in this specific snippet, Code Snippet is a fundamental library for numerical computing in Python. Code Snippet is built on top of code snippet arrays, so it's often imported when working with code snippet data structures, and many code snippet operations return code snippet arrays under the hood. Code Snippet. This module provides a way of using operating system-dependent functionality, such as reading or writing to the file system. It's good practice to include it if you anticipate file operations, even if not immediately used in the core scraping logic, as it provides cross-platform compatibility for file paths. Building the web scraper function. Encapsulating our scraping logic within a function makes the code reusable, modular, and easier to manage. We'll name our function Code Snippet. Step 1. Defining the target and request headers. The first part of our function will define the URL of the Wikipedia page and set up HTTP request headers. Headers, especially the code snippet, are crucial because some websites block requests that don't appear to originate from standard web browser. Download the code on OnePageCode Substack. Code Snippet. This is the specific Wikipedia page we're targeting. Code Snippet. This dictionary contains HTTP headers that will be sent with our request. The code snippet header tells the web server what kind of client is making the request. Using a common browser's code snippet string helps mimic a legitimate browser visit, reducing the chances of being blocked or flagged as a bot. Other common headers include code snippet, what content types the client prefers, code snippet, the URL of the page that linked to the current request, and code snippet. Step 2. Sending the HTTP request with robust error handling. Robust code anticipates potential failures. Web requests can fail due to network issues, server errors, or being blocked by the website. A code snippet block is essential here to gracefully handle such situations, preventing our script from crashing unexpectedly. Download the code on OnePageCode Substack. Code Snippet sends an HTTP GET request to the specified code snippet. We include our code snippet to improve the chances of a successful request and a code snippet in seconds to prevent the script from hanging indefinitely if the server is unresponsive. Code Snippet. This method is a convenient way to check if the request was successful. If the HTTP status code indicates an error, e.g., 404 not found, 500 internal server error. It raises in code snippet. Code snippet block catches various code snip. Pet exceptions, providing specific feedback for different types of failures. Code snippet for errors returned by the server, e.g., incorrect URL, server issues. Code snippet for network-related issues before a connection is even established, e.g., no internet connection, DNS resolution failure. Code snippet if the server doesn't respond within the specified code snippet duration. Code snippet, a base class for all exceptions in code snippet, serving as a catch-all for any other unforeseen issues. Returning code snippet. In case of any error, the function returns code snippet, which allows us to check for successful data retrieval later and handle failures gracefully. Step 3. Parsing HTML content with BeautifulSoup. Once we have the HTML content, we use BeautifulSoup to parse it into a navigable tree structure. This tree allows us to easily search for and extract specific HTML elements. Download the code on OnePageCode Substack. Code snippet initializes a BeautifulSoup object. Code snippet gives us the raw binary content of the HTML page, and code snippet is the default, highly performant parser that code snippet uses to interpret the HTML string into a tree of Python objects. Step 4. Identifying and extracting the correct table. Wikipedia pages often contain multiple tables, e.g., infobox, historical data, references. We need to find a specific table that lists the current DJIA constituents. Download the code on OnePageCode Substack. Code snippet T. His method searches the entire parsed HTML document for all occurrences of the code snippet tag and returns them as a list of BeautifulSoup tag objects. Code snippet. This powerful pandas function reads HTML tables directly into a list of data frames. We convert the list of BeautifulSoup table objects to a string representation, code snippet, because code snippet can process a string containing HTML. The significance of code snippet. This is a critical point. Code snippet returns a list of data frames, one for each table it successfully parses. The code snippet index means we are selecting the second table in that list. Python lists are zero-indexed. How to determine this index? This usually requires manual inspection using browser developer tools. 1. Open the Wikipedia page in your web browser. 2. Right-click on the specific table you want to scrape, the DJIA constituents table. 3. Select Inspect or Inspect Element. 4. In the Developer Tools panel, navigate up the HTML tree to locate the code snippet tag. Observe its position relative to other tables, or look for unique attributes like code snippet or code snippet. You can also test code snippet, etc. in a Python console to see which data frame corresponds to the correct table. Making it more robust, relying solely on numerical index, code snippet, is fragile as page structures can change. A more robust approach uses BeautifulSoup's ability to select elements by specific attributes, e.g., code SN, IPIT, code snippet, or CSS selectors. For example, if the DJIA table had a unique class code snippet, you could use code snippet to directly target it, or code snippet which returns a list. This makes your scraper more resilient to minor page layout changes. Step 5. Cleaning the data frame. The scraped data frame might contain irrelevant columns or require renaming for consistency. For the DJIA constituents table, there's often a notes column we don't need, and we want to ensure we have the symbol and company columns. Download the code on OnePageCode Substack. Code snippet. This line removes the column named Notes from the data frame. Code snippet. This parameter is crucial. When code snippet, the method modifies the data frame directly without returning a new data frame. This is generally more memory efficient for large data frames, as it avoids creating a copy. If code snippet, the default, the method would return a new data frame with a column dropped, and you'd need to assign it back, e.g., code snippet. Column checks. It's good practice to verify that the expected columns, code snippet, exist after scraping, as their absence would indicate a significant change in the website structure or an incorrect table selection. executing the scraper and extracting tickers. Now that our code snippet function is defined, we can call it to get our data frame and then extract the list of ticker symbols. We'll also add a check to ensure the scraping was success. Full. Download the code on one page code Substack. Code snippet. This check ensures that the code snippet function succeeded in returning a data frame and that the data frame actually contains data, i.e., it's not just an empty data frame. This is a robust way to handle potential scraping failures and prevents errors in subsequent operations. Code snippet. Code snippet selects the symbol column from the data frame, which results in a panda series. Code snippet converts this panda series into a number py array. This is often more efficient than directly converting a series to a list for very large data sets, as number py arrays are optimized for numerical operations. Code snippet converts the number py array into a standard Python list. This list of ticker symbols is exactly what we need for the next step: downloading historical financial data, persisting the data for future use. For robustness and to avoid rescraping every time the script runs, especially considering the fragility of web scraping, it's good practice to save the extracted data. CSV, comma-separated values, is a common, human-readable format for tabular data that can be easily loaded back into a pandas data frame. Download the code on one page code Substack. Code snippet. This method saves the data frame to a CSV file at the specified code snippet. Code snippet prevents pandas from writing the data frame index as a column in the CSV. This is usually desired, as the index often just represents row numbers and isn't part of the actual data. Connecting to the next step, downloading financial data. With our code snippet list in hand, the next logical step in implementing our momentum trading strategy is to download historical price data for these symbols. Libraries like CodeSnippet provide a convenient wrapper around Yahoo Finance's public API, making this straightforward. Download the code on one page code Substack. CodeSnippet imports the code snippet library, commonly aliased as CodeSnippet. CodeSnippet. This function from CodeSnippet downloads historical market data. CodeSnippet. A list of ticker symbols for which to download data. CodeSnippet specifies the duration of data to download, e.g., code snippet for 1 month, code snippet for 1 year, code snippet for all available data. Code snippet specifies the data frequency, e.g., code snippet for daily, code snippet for weekly, code snippet for hourly. The resulting code snippet data frame will typically have a multi-index for columns, e.g., code snippet, code snippet, code snippet, code snippet, code snippet, code snippet for each ticker, making it ready for further analysis. This initial data acquisition step is fundamental. With the ticker symbols and historical data, we can proceed to calculate momentum indicators and develop our trading strategy. Downloading stock prices. A fundamental first step in any quantitative trading strategy, including momentum trading, is acquiring reliable historical price data for the assets you intend to analyze. This section focuses on using the popular code snippet Python library to efficiently download stock price data. Introduction to Code Snippet. Code Snippet is a powerful and convenient open-source library that allows you to download historical market data from Yahoo Finance. It's built on top of Code Snippet and provides a straightforward interface to access various financial data points, including open, high, low, close, adjusted close prices, and trading volume. Before using Code Snippet, ensure it's installed in your Python environment. If not, you can install it via pip. Download the code on one page code Substack. We also need to import the necessary libraries for our work: Code Snippet for data downloading, Code Snippet for data manipulation, and Code Snippet for basic visualization. Download the code on one page code Substack. Here, we import Code Snippet and Code Snippet, aliasing them as Code Snippet and Code Snippet respectively for convenience. Code Snippet is imported for plotting. The Code Snippet lines are optional, but helpful for displaying wider data frames in your console or notebook without truncation, making it easier to inspect the downloaded data. Downloading data for a single stock. To understand the basics, let's start by downloading data for a single stock. Apple Incorporated, APL, for a specific period. Download the code on one patch code Substack. In this code block, we specify code snippet as our code snippet and define a 1-year period from code snippet to code snippet. The code snippet function takes the ticker symbol or a list of symbols as its first argument, followed by code snippet and code snippet dates. The function returns a code snippet containing the requested historical data. Let's inspect the first few rows and the structure of the downloaded data. Download the code on one patch code Substack. The code snippet method shows the initial rows, giving us a quick look at the data format. The code snippet method provides a summary including the data frame's index, column names, non-null values count, and data types. You'll notice columns like code snippet, code snippet, code snippet, code snippet, code snippet, and code snippet. The data frame's index is a code snippet, which is crucial for time series analysis as it allows for easy date-based operations and plotting. Each row represents a trading day, and the index accurately reflects the date of that day's trading activity. Understanding adjusted close price. Among the various price columns, the code snippet, adjusted close price, is almost always the preferred choice for quantitative analysis and strategy backtesting. Why? ADJ close is preferred. Accounts for corporate actions. The standard code snippet price only reflects the closing price of the stock on a given day. The code snippet price, however, is modified to reflect any corporate actions that affect the stock's price per share. These actions primarily include stock splits. If a company undergoes a 2-for-1 stock split, the share price effectively halves and the number of shares doubles. The code snippet price is adjusted retrospectively for all historical data to reflect this change, making past prices comparable to current prices on a per-share basis. Dividends. When a company pays a cash dividend, its stock price typically drops by the dividend amount on the ex-dividend date. The code snippet price is adjusted downwards to account for these dividend payouts, making it appear as if the price never dropped due to the dividend. This is crucial because dividends represent a return to shareholders, and ignoring them would underestimate the total return of an investment. Stock dividends/spin-offs. Similar adjustments are made for other less common corporate actions. Accurate return calculation. Using code snippet ensures that your calculated returns, daily, weekly, monthly, accurately reflect the total return of an investment over time, including the impact of dividends and splits. If you use the simple code snippet price, your historical returns will be distorted, especially for stocks that have undergone splits or paid significant dividends. For momentum strategies, where we compare past performance, using code snippet is paramount to ensure a fair and consistent comparison of returns across different periods and different assets. Downloading data from multiple stocks. In a momentum trading strategy, you typically analyze a portfolio of stocks, not just one. We'll use a list of ticker symbols, such as the Dow Jones Industrial Average, DJIA components, which we would have obtained in a previous step. For demonstration, we'll define a small sample list here. Download the code on one patch code Substack. When code snippet is called with a list of tickers, it returns a code snippet with a code snippet for its columns. This means that each financial metric, open, high, low, close, ADJ close, volume, becomes a top-level column, and beneath each of these, there are subcolumns for each ticker. Let's examine the structure of code snippet. Download the code on one patch code Substack. The output of code snippet will show columns like code snippet, etc., grouped under top-level headers like code snippet, etc. This code snippet structure is code snippet, way of efficiently organizing hierarchical data. For momentum calculations, we typically only need the code snippet prices for all stocks. We can select this specific level from the code snippet data frame. Download the code on one patch code Substack. By selecting code snippet, we obtain a new code snippet where the columns are now simply the ticker symbols, and the values are their respective adjusted closing prices. This clean code snippet is ideal for subsequent calculations like the DJIA returns. Advanced code snippet parameters, code snippet. Beyond code snippet and code snippet dates, code snippet offers other useful parameters. A common one is code snippet, which allows you to specify the time granularity of the data, e.g., weekly, monthly. The default is code snippet daily. Common code snippet values include code snippet daily default, code snippet weekly, code snippet monthly, code snippet quarterly. Download the code on one patch code Substack. Using code snippet retrieves data where each row represents a week's trading activity, typically ending on the last trading day of the week. This is useful if your strategy operates on a lower frequency, such as weekly or monthly rebalancing. Robust data acquisition with error handling. When downloading data, especially from many tickers or over unstable network connections, errors can occur. Common issues include network timeouts, invalid ticker symbols, or API rate limits. Implementing code snippet blocks makes your data acquisition process more robust. Download the code on one patch code Substack. This code snippet block attempts the download. If an code snippet occurs, e.g., code snippet cannot retrieve data for an invalid ticker or a network issue, the program will not crash. Instead, it will catch the error and print a user-friendly message, guiding you on how to troubleshoot. It's also important to check if the resulting data frame is empty or contains the expected data, as code snippet might ask. Sometimes return partial data, even if some tickers fail. Data quality considerations. While code snippet is convenient, it's essential to be aware of potential data quality issues that can arise from any free data source. Missing data points. Occasionally, data for certain days or even entire periods might be missing due to data provider issues or stock delistings. API rate limits. Frequent or large download requests might temporarily trigger rate limits, leading to failed downloads. Discrepancies. Minor discrepancies might exist between different data providers. For robust production systems, consider paying for premium data feeds that offer higher reliability, better data quality, and dedicated support. For educational purposes and most personal projects, code snippet is generally sufficient. If you encounter missing data, common workarounds include /backward fill, filling missing values with the last known good value, code snippet. Interpolation, estimating missing values based on surrounding data points, code snippet. Resampling, changing the frequency of the data, e.g., from daily to weekly, to smooth out missing daily points. Visualizing downloaded data. Visualizing the adjusted close prices is a great way to quickly confirm your data download and get a feel for the price movements. Download the code on one patch code Substack. This code snippet uses code snippet built-in plotting functionality, which leverages code snippet to quickly visualize the PRI. See trends of Apple, Microsoft, and Google. The code snippet argument controls the plot's dimensions, and code snippet, and code snippet enhance readability. This immediate visual feedback helps verify that the data was downloaded correctly and provides an intuitive understanding of the stock's historical performance. Connecting to momentum strategy. The code snippet data frame we have meticulously prepared is the direct and critical input for the next step in implementing our momentum trading strategy, calculating historical returns. Momentum strategies are fundamentally built on the idea that assets that have performed well recently, i.e., had strong positive returns, will continue to perform well in the near future. Therefore, accurately calculating these returns from the adjusted closing prices is the very foundation upon which our strategy will be built. Calculating monthly returns. Transforming raw daily stock prices into meaningful metrics is a fundamental step in quantitative finance. For strategies like momentum, which often evaluate performance over longer periods, e.g., monthly or quarterly, it's essential to convert high-frequency daily price data into lower-frequency returns. This section focuses on calculating monthly compounded returns from daily price data using powerful Pandas time series functionalities. The challenge of multi-period returns. Why compounding matters. When dealing with returns over multiple periods, e.g., converting daily returns into a monthly return, a common pitfall is simply summing the daily returns. This is incorrect because returns compound over time. Compounding means that the return in one period affects the base on which the next period's return is calculated. Consider a simple example. Day 1. Stock price increases by 10%, return of 0.10. Day 2. Stock price decreases by 5%, return of minus 0.05. If you simply sum the returns, 10 cents plus minus 0.05 equals 5 cents or 5%. However, let's look at the actual price movement starting with an initial price of $100. End of day 1. $100, 1 plus 0.10 equals $110. End of day 2, $110, 1 to 0.05 equals $104.50. The total return over 2 days is code snippet, or 4.5%. This differs from the 5% obtained by a simple summation. The correct way to calculate the multi-period return is by compounding. $, 1 plus R total equals 1 plus R1, 1 plus R2, 1 plus Rn, $. Cifrão R total igual 1 mais R1, 1 mais R2. 1 plus Rn, $1, where $Rn is the simple return for period code snippet. This is why we use simple returns for this type of calculation, as they are additive when expressed as code snippet and multiplicative over multiple periods. Logarithmic returns, while useful for some statistical analyses, are additive over time, but require a different conversion back to simple returns for portfolio value calculations. Step 1. Calculating daily simple returns with code snippet. The first step in deriving monthly returns from daily prices is to calculate the daily percentage change, which represents the daily simple return. Pandas provides a convenient method called code snippet for this purpose. Let's start by setting up a sample data frame of daily adjusted closing prices. This code snippet will mimic the data obtained from the downloading stock prices section. We'll use a small data set for clarity, ensuring it spans at least 2 month ends to demonstrate monthly resampling. Download the code on one patch code Substack. The output shows our initial data frame with daily prices. Download the code on one patch code Substack. Now, we apply the code snippet method to calculate the daily returns for each stock. Download the code on one patch code Substack. The result is a data frame where each value represents the percentage change from the previous day's price. Download the code on one patch code Substack. Notice the code snippet values in the first row. This is expected because code S. Snippet requires a prior value to calculate a percentage change, and there is no preceding data point for the very first entry. Pandas handles this gracefully, and these code snippets will not affect subsequent calculations when aggregating. Step 2. Resampling data to monthly frequency with code snippet. After obtaining daily returns, the next step is to group these daily returns into monthly periods. Panda's code snippet method is specifically designed for this task, allowing you to change the frequency of time series data. To illustrate how code snippet works, let's use a simpler series example, similar to how it might be introduced in a basic Pandas tutorial. Download the code on one patch code Substack. The dummy series looks like this. Download the code on one patch code Substack. Now, we can resample this series to a 3-minute frequency and apply an aggregation function, like code snippet. Download the code on one patch code Substack. The output clearly shows how code snippet groups the data. Download the code on one patch code Substack. When you call code snippet on our code snippet, it doesn't immediately return a new data frame. Instead, it returns a code snippet object. This object is a special group by object that holds the logic for how the data should be grouped, e.g., by month. You then need to apply an aggregation method, like code snippet, or a custom function using code snippet, to this code snippet object to get the final aggregated data frame. The string argument passed to code snippet specifies the new frequency. Common frequency strings include code snippet for daily, code snippet for weekly, code snippet for month-end frequency, the last day of the month, code snippet for month start frequency, the first day of the month, code snippet for quarter end, code snippet for year end, code snippet for hourly, code snippet for minute, code snippet for second. For financial data, using code snippet, month end, is typical for momentum calculations as it aligns with how many official financial reports or performance periods are structured. Using code snippet, month start, could also be valid depending on the specific strategy's look-back period definition. Let's apply code snippet to our code snippet. While we can't directly print the code snippet object in a readable data frame format, we can demonstrate its grouping behavior by applying a simple aggregation like code snippet to see how many daily entries fall into each monthly bucket. Download the code on OnePageCode Substack. This output shows how many daily data points are in each monthly group, confirming the grouping. Download the code on OnePageCode Substack. As you can see, January has 21 business days in our sample, and February has 4, as our sample data ends on February 3rd, 2023. Step 3. Compounding returns with code snippet and lambda functions. With the daily returns grouped by month, the final step is to apply the compounding logic to calculate the overall MO. Monthly return for each stock. This is achieved using the code snippet method on the code snippet object, combined with a code snippet function to define our custom compounding logic. Recall our compounding formula. $R total equals 1 plus or 1, 1 plus or 2, 1 plus Rn, $1. In pandas, the product of a series of numbers can be calculated using the code snippet method. So, for a series code snippet representing daily returns for a month, the formula becomes code snippet. Let's walk through a concrete example of compounding a few daily returns manually to solidify the concept. Suppose a stock had the following daily returns in a given month. Day 1, plus 1%, 0.01. Day 2, minus 0.5%, minus 0.005. Day 3, plus 2.0%, 0.02. 1. Add 1 to each return. Code snippet. Code snippet. Code snippet. 2. Calculate the product of these values, compounding. Code snippet. 3. Subtract 1 to get the overall simple return for the period. Code snippet, or 3.499%. This 3.499% is the correct compounded return for the month. This exact logic is what our code snippet function will implement. A code snippet function is a small, anonymous function in Python. It's often used for short, simple operations where defining a full code snippet function would be overkill. The syntax code snippet creates a function that takes code snippet and returns the result of code snippet. In our case, the code snippet function will be applied to each monthly group for each stock column. When code snippet applies the lambda, code snippet will represent a pandas series containing all the daily returns for a specific stock within a specific month. Now, let's put it all together. Download the code on OnePageCode Substack. The final code snippet will contain the compounded monthly returns. Download the code on OnePageCode Substack. Let's break down the single chain line. 1. Code snippet. As discussed, this generates a data frame of daily simple returns. The first row for each stock will be code snippet. 2. Code snippet. This takes the daily returns data frame and groups all the daily returns by calendar month, creating a code snippet object. 3. Code snippet. This is the critical aggregation step. Code snippet applies a specified function to each group created by code snippet. For each monthly group, e.g., all daily returns for January for Apple, code snippet passes that group's data as a pandas series code snippet to our code snippet function. Code snippet. This transforms each daily return code snippet into code snippet, preparing it for multiplication. Code snippet. This method calculates the product of all values in the series code snippet. This effectively performs the compounding multiplication code snippet. By default, code snippet skips code snippet values, which is convenient for the initial code snippet from code snippet. Code snippet. Finally, 1 is subtracted from the product to convert the compounded growth factor back into a simple return for the entire month. This powerful, concise line of code effectively transforms daily price data into the monthly compounded returns needed for many quantitative trading strategies, including momentum, handling missing data, and edge cases. While the code snippet method automatically introduces code snippet for the very first data point in a series, Panda's code snippet method, used within our Lambda function, by default handles code snippet values by skipping them, code snippet. This means that if you have a code snippet within a month's daily returns, e.g., due to missing data for a specific day, code snippet will calculate the product of the non-code snippet values. However, it's crucial to be aware that true missing price data, not just the initial code snippet from code snippet, can impact the accuracy of your compounded returns. For instance, if a stock had no trading on a particular day, that day's return would implicitly be zero if you simply ignored it, which might not be correct. For robust analysis, it's often a best practice to explicitly handle missing price data, e.g., by forward filling or interpolating prices before calculating code snippet, if your dataset is known to have gaps beyond non-trading days. For the purposes of this tutorial, we assume the input daily price data code snippet is complete for trading days. Summary of the process. The calculation of monthly compounded returns is a three-stage process, elegantly handled by Pandas. 1. Calculate daily simple returns. Use code snippet on the daily adjusted close prices. 2. Group by month. Use code snippet to create monthly bins of daily returns. 3. Compound within groups. Apply a custom aggregation code snippet to each monthly group to correctly compound the daily returns into a single monthly return. This transformed data, code snippet, is now perfectly suited for subsequent steps in constructing and backtesting momentum trading strategies, such as ranking stocks by their past performance. Calculating the 6-month terminal return. A core component of any momentum strategy is the calculation of a historical performance metric that truly reflects asset growth over a specified look-back period. For our strategy, we will use the 6-month terminal return as our primary momentum indicator. This metric captures the compounded growth of an investment over the past 6 months, providing a robust signal for identifying trending stocks. Understanding compounded returns versus simple averages. Before diving into the code, it's crucial to understand why we calculate compounded returns instead of simply averaging monthly returns. Imagine an asset with the following monthly simple returns. Month 1, plus 10%, 0.10. Month 2, minus 5%, minus 0.05. Month 3, plus 12%, 0.12. A simple arithmetic average of these returns would be code snippet or 5.67%. This average, while mathematically valid, does not accurately represent the actual growth of an initial investment over these 3 months. It ignores the effect of returns building upon previous returns. Let's track an initial investment of $100 to see the true compounded growth. Initial investment, $100. After month 1, $100, 1 plus 0.10 equals $110. After month 2, $110, 1 to 0.05 equals $104.50. After month 3, $104.50, 1 plus 0.12 equals $117.04. The actual terminal value after 3 months is $117.04 from an initial $100. The total compounded return, or terminal return, is calculated as code snippet or 17.04%. This demonstrates that to correctly calculate the growth over multiple periods, we must multiply the code snippet factors for each period. This is precisely what financial compounding entails. The mathematical operation for this is taking the product, code snippet, of these growth factors, rather than a sum or mean. Preparing returns for compounding. Our code snippet data frame, generated in the previous section, contains simple monthly percentage returns, e.g., 0.05 for 5%. To perform compounding, we first need to convert these into growth factors by adding 1 to each return. This transforms a return code snippet into code snippet. Let's first ensure we have code snippet and code snippet imported and simulate code snippet for demonstration purposes. In a real application, code snippet would be the output from the calculating monthly returns section. Download the code on one patch code Substack. The code snippet holds the simple monthly returns for each stock. Now, we perform the transformation. Download the code on OnePageCode Substack. By adding 1 to each return, a 5% return, 0.05, becomes 1.05, and a minus 2% return, minus 0.02, becomes 0.98. These values directly represent the multiplicative factor by which an investment grows or shrinks in a given period. Applying a rolling window for momentum calculation. A momentum strategy requires looking back a specific number of periods to assess past performance. Panda's code snippet method is perfectly suited for this. It creates a rolling window over the data, allowing you to apply a function to each window sequentially. We specify a code snippet size, which for our 6-month momentum strategy will be code snippet. Download the code on OnePageCode Substack. The code snippet method returns a code snippet object. This object doesn't immediately compute anything. It's a generator that defines how the windows should be created. We then need to chain an aggregation method, like code snippet, or in our case, code snippet, to perform the actual calculation on each window. Compounding returns with code snippet. Now, we apply the code snippet function to each 6-month rolling window of our code snippet data frame. Code snippet calculates the product of all elements within an array or series, which is exactly what we need for compounding returns. Download the code on OnePageCode Substack. You'll notice code snippet, not a number, values for the first 5 rows. This is due to the default behavior of code snippet, where the code snippet argument is implicitly set to the code snippet size, which is 6 in our case. This means that a calculation will only be performed if there are at least 6 non-9 values in the current window. Since the first 5 rows do not have 6 preceding data points, their rolling window results in code snippet. For instance, the value for the 6th month's row will be the product of the first 6 months code snippet values. Converting back to percentage terminal return, the code snippet data frame now holds values representing the total growth factor, e.g., 1.1704 from our earlier example. To get the actual percentage return, 17.04%, we simply subtract 1 from these values. This converts the compounded growth factor back into a simple percentage return format. Download the code on OnePageCode Substack. The code snippet now contains the 6-month compounded returns for each stock, aligned with the end of each month. These values represent the momentum signal we will use for stock selection. Handling missing values, code snippet. As observed, the initial periods of code snippet contain code snippet values because there weren't enough preceding data points to form a complete 6-month window. These code snippets need to be managed before using the data for strategy implementation or backtesting, as many financial operations or model inputs require complete data. Common approaches include dropping rows with code snippets. This removes any periods where a full 6-month momentum signal cannot be calculated for any stock. This is often the simplest and most robust approach for backtesting momentum strategies, as it ensures all signals used are based on complete look-back periods. Filling code snippets. Replacing code snippets with a specific value, e.g., 0, or the mean/median of available data, is an option, but it can introduce look-ahead bias or distort the signal. Generally, for time series-dependent indicators like momentum, dropping rows with code snippets is preferred to maintain data integrity. Download the code on OnePageCode Substack. Notice how the number of rows has decreased as the initial rows containing code snippets were removed. This is a standard procedure to ensure all data points used for analysis or trading decisions are valid and complete. The rationale behind the look-back window. The choice of a 6-month look-back window for a momentum strategy is a common and empirically supported practice in quantitative finance. While the optimal look-back period can vary depending on market conditions, asset classes, and specific investment goals, research by pioneers in momentum investing, such as Jagadish Titman and Narasimhan Jagadish, e.g., their seminal 1993 paper, Returns to Buying Winners and Selling Losers, has often pointed to intermediate-term horizons, typically 3 to 12 months, with 6 months being a frequently cited sweet spot, as effective for capturing the momentum effect. It's important to acknowledge that selecting an optimal look-back period through extensive historical testing on a given dataset can lead to a phenomenon known as data snooping or overfitting. This occurs when a strategy is specifically tailored to past data, potentially performing poorly on new, unseen data. For this foundational material, we adopt a commonly accepted period. Advanced techniques to mitigate data snooping and ensure the robustness of a strategy will be discussed in later sections on backtesting and robust strategy design. Practical application of T. Momentum indicator. The code snippet data frame, after handling code snippets, is now our central momentum indicator. Each value represents the 6-month compounded return for a specific stock at a specific point in time. In the subsequent steps of our strategy, we will use this data frame to 1. Rank stocks. At the end of each month, we will rank all available stocks based on their code snippet values. Stocks with higher positive 6-month returns indicate stronger upward momentum. 2. Select top performers. We will then identify the top code snippet stocks, e.g., the top 10% or top 20 stocks with the highest momentum. 3. Form portfolios. These top code snippet stocks will form our long portfolio for the upcoming month, held until the next rebalancing period. This code snippet is therefore a critical input for the portfolio construction and backtesting phases of our momentum trading strategy, enabling us to systematically identify and invest in assets exhibiting strong recent performance. Implementing the momentum trading strategy. Generating trading signals. Systematic trading strategies, particularly momentum-based ones, rely on precise rules to identify trading opportunities. The process of generating trading signals involves using historical data to determine which assets to buy, go long, and which to sell, go short, at a specific point in time. This section will detail the critical steps for generating these signals, emphasizing the importance of defining time periods correctly and avoiding common pitfalls like data snooping. Understanding the time context, measurement, formation, and performance periods. A fundamental aspect of designing and backtesting any quantitative trading strategy is the rigorous definition of time periods. Misunderstanding or incorrectly implementing these periods can lead to inaccurate results and, more importantly, strategies that appear profitable in backtests but fail in live trading due to data snooping or look-ahead bias. Let's define the 3 crucial periods. 1. Measurement period or look-back period. This is the historical window over which we calculate a specific indicator or characteristic of an asset. For a momentum strategy, this is the period used to compute the past returns, e.g., the 6-month terminal return. This period ends at the point where we make our decision. 2. Formation period. This is the precise point in time when the trading signal is formed or generated. It's the moment when you make your decision based on the data available up to the end of the measurement period. In many strategies, the formation period is synonymous with the end of the measurement period. 3. Performance period or holding period. This is the future period during which the strategy's performance is evaluated or the assets selected are held. For instance, if you form a signal at the end of July, you might hold the selected stocks for the entire month of August and evaluate their returns over that month. This period starts immediately after the formation period. It's crucial that the data used for signal generation from the measurement period is only data that would have been historically available at the beginning of the performance period, i.e., at the formation period. The pitfall of data snooping, look-ahead bias. Data snooping, also known as look-ahead bias, is one of the most insidious errors in quantitative strategy development. It occurs when information that would not have been available at the time a trading decision was made is implicitly or explicitly used to generate that decision. Why it's a problem: imagine you're making a trading decision on July 31st, 2022 for the month of August. If your calculation of the 6-month terminal return for a stock accidentally includes its performance from August 2022, you are using future information that you wouldn't have known on July 31st. This makes your strategy appear more profitable than it would be in reality, as it's peaking into the future. Such a strategy would perform poorly or unpredictably in live trading, as it relied on information that was not genuinely available at the time of the simulated decision. Concrete example. Suppose you're calculating a 6-month momentum for a signal to be used on August 1st, 2022. The correct measurement period would be from February 1st, 2022 to July 31st, 2022. The signal is formed on July 31st. The performance period starts August 1st. If, by mistake, your data slicing includes returns up to, say, August 15th, 2022, while generating the signal for August 1st, you have introduced look-ahead bias. The strategy would know how stocks perform for the first half of August before making its decision, leading to artificially inflated backtest results. To avoid data snooping, we must ensure that all data used to generate a signal for a specific date, the formation period, comes strictly from before or on that date. Our 6-month terminal return, by definition, is calculated using prices available up to the end of the measurement period, which aligns perfectly with this principle. Defining key dates for signal generation. The first step in generating a signal is to precisely define the critical timestamps that delineate our measurement, formation, and performance periods. While in a full backtest, these dates would iterate through time. For this example, we will hard-code specific dates to illustrate the process for a single trading decision. We will set the code snippet to July 31st, 2022. This means our 6-month terminal returns will be calculated up to this date. Our code snippet will also be July 31st, 2022, as this is when we decide on our portfolio for the next month. The code snippet will then be August 2022. Download the code on OnePageCode Substack. This initial code chunk sets up the temporal context for our trading decision. We use Python's built-in code snippet module to create specific data objects. Code snippet is the crucial timestamp. It's the latest point in time for which we allow data to influence our decision. Any data beyond this date must be considered future and must not be used. Code snippet is simply the day immediately following our decision point, marking the beginning of the period during which our chosen portfolio will be active. Dynamic date determination enhancement. In a real-world backtesting system, you wouldn't hard-code these dates. Instead, you'd iterate through all available historical data, typically month by month or quarter by quarter. For instance, if code snippet is indexed by date, you could find the last available date in the data frame to set your code snippet dynamically. Download the code on OnePageCode Substack. This commented snippet illustrates how one might dynamically determine the code snippet in a live system or a comprehensive backtest. By finding the maximum date in our code snippet, which contains our historical 6-month returns, we ensure that our signal generation always uses the most recent available information without introducing look-ahead bias. This makes the strategy robust and adaptable to new data. Extracting momentum data at the decision point. With our code snippet defined, the next step is to extract the 6-month terminal returns for all stocks exactly at that point in time. This gives us a snapshot of each stock's momentum as of July 31st, 2022. We assume code snippet, generated in previous sections, contains the 6-month terminal returns for all stocks, indexed by date. Download the code on OnePageCode Substack. Here, we use code snippet to perform label-based indexing, specifically selecting the row or rows if the index isn't unique, corresponding to our defined code snippet. This extracts all ticker symbols and their associated 6-month returns for that specific date. The code snippet method is then called to convert the series index, which contains the ticker symbols, into a regular column, making it easier to work with. Finally, we rename the columns to code snippet and code snippet for better readability. Identifying extreme performers, basic selection. Before diving into quantile-based selection, let's consider a simpler approach. Identifying the single best and single worst performing stock based on our 6-month momentum. This demonstrates the use of code snippet and code snippet. Download the code on OnePageCode Substack. This snippet uses code snippet and code snippet on the code snippet column of our code snip. These pandas series methods return the index of the maximum or minimum value, respectively. Since we reset the index and renamed columns, the code snippet values are now in the second column, index 1. Thus, code snippet is used to select all rows, code snippet, of the second column, code snippet. The result is the ticker symbol of the stock with the highest/lowest momentum. This approach is useful for quickly identifying outliers, but is generally too simplistic for forming diversified portfolios. Quantile-based stock selection with code snippet. While picking the single best or worst stock might seem intuitive, it's rarely a robust strategy. Quantitative trading often involves forming portfolios of multiple assets to diversify risk and capture broader market trends. A common approach is to rank all available assets based on a specific metric, like momentum, and then select those falling into the top and bottom quantiles. Code snippet functionality. The code snippet function is designed to discretize a continuous variable into code snippet equal size bins based on sample quantiles. This means each bin, or quantile, will contain approximately the same number of observations. For example, if you divide data into 5 quintiles, the top 20% of values will fall into the highest quintile, the next 20% into the next highest, and so on. This is ideal for ranking stocks for portfolio formation. Rationale for choosing quantiles, e.g. quintiles. The choice of the number. BER of quantiles, e.g. 5 for quintiles, 10 for deciles, depends on the specific strategy, the number of assets in the universe, and practical considerations like transaction costs and desired portfolio concentration. Quintiles, 5 quantiles, a common choice in academic research, e.g. Fama-French factors. It provides a good balance between sufficient differentiation among stocks and having enough stocks in each group for diversification. The top 20% of performers are typically chosen for the long portfolio and the bottom 20% for the short portfolio. This offers a reasonable number of stocks in each extreme group for diversification while still capturing strong momentum signals. Deciles, 10 quantiles, offers finer granularity, allowing for selection of, say, the top 10% and bottom 10%. This can lead to more concentrated portfolios, potentially increasing risk if individual stock selection is poor, but also potentially increasing alpha if the momentum signal is very strong at the extremes. Tertiles, 3 quantiles, less granular, often used when the asset universe is smaller. It provides broader buckets, which might be less precise for capturing extreme momentum. The key is that code snippet ensures an equal number of observations in each bin, rather than equal-sized ranges of values. This is important when the distribution of returns is skewed, as it ensures an even distribution of stocks across the ranks. Let's first see code snippet in action with a simple example. Download the code on OnePageCode Substack. In this example, we generate 20 random returns and then apply code snippet to divide them into 5 quantiles. Code snippet specifies 5 quantiles. Code snippet tells code snippet to return integer labels 0, 1, 2, 3, 4 instead of interval objects. Code snippet handles cases where identical values might prevent unique bin edges, preventing errors. The code snippet output shows that each quantile, 0 to 4, contains roughly the same number of stocks, for in this case, 20 stocks/5 quantiles equals 4 stocks/quantile. This confirms the equal-sized binning characteristic of code snippet. Applying code snippet to our momentum data. Now, we'll apply this to our code snippet to assign a momentum rank to each stock. We'll use 5 quantiles, labeling them 0 through 4, where 4 represents the highest momentum quantile. Download the code on OnePageCode Substack. This chunk is central to our signal generation. We add a new column named Code Snippet to our data frame. Code Snippet takes the Code Snippet column, divides it into 5 quantiles, and assigns an integer label, 0 to 4, to each stock based on which quantile its return falls into. The Code Snippet argument is a best practice to prevent errors if there are many identical return values, which can make it impossible to create strictly unique quantile boundaries. The code snippet check is crucial to confirm that stocks are indeed distributed relatively evenly across the quantiles, which is the primary purpose of code snippet. Edge cases for code snippet. While code snippet is powerful, it can encounter issues. Too few unique values. If your data has many identical values, code snippet might not be able to create unique bin edges for the specified number of quantiles. The code snippet argument helps mitigate this by adjusting the number of bins if necessary, but it's good to be aware. If code snippet is used, the actual number of quantiles might be less than code snippet. Too few data points. If your data frame has fewer rows than the number of quantiles you specify, e.g., trying to create 5 quantiles from only 3 stocks, it will raise an error. Ensure your universe of stocks is sufficiently large relative to code snippet. A common rule of thumb is to have at least code snippet unique values, and preferably more. Constructing long and short portfolios. With the stocks now ranked by their 6-month momentum, we can programmatically identify which stocks belong to our long portfolio, top performers, and which belong to our short portfolio, bottom performers. For a typical momentum strategy, we would go long the stocks in the highest momentum quantile and short the stocks in the lowest momentum quantile. Given our 0 to 4 ranking, quantile 4 represents the highest momentum and quantile 0 represents the lowest. Download the code on one patch code Substack. This final code chunk for signal generation uses Boolean indexing to filter our code snippet. We create 2 new data frames. Code snippet contains all stocks where the code snippet is 4, highest momentum, and code snippet contains stocks where the code snippet is 0, lowest momentum. Finally, we extract just the code snippet column from these filtered data frames and convert them to Python lists using code snippet. These lists, code snippet and code snippet, represent the actionable trading signals, the specific assets to be bought and sold for the upcoming performance period. Modularizing the signal generation logic for robustness and reusability. Especially when building a full backtesting framework, it's best practice to encapsulate this signal generation logic within a function. This makes the code cleaner, easier to test, and allows for dynamic application over various time periods. Download the code on one patch code Substack. Encapsulating the signal generation logic into a function like code snippet significantly improves code organization and reusability. It takes the code snippet, and the desired code snippet as inputs, returning the lists of long and short stock tickers. This function also includes basic error handling for code snippet, if no data exists for the code snippet, and a check for insufficient data points for code snippet, making it more robust for real-world application. Integrating into a larger backtesting framework and practical considerations. The signal generation process described here is a foundational component of a full quantitative trading strategy. In a complete backtesting framework, this code snippet function will be called iteratively for each rebalancing period, e.g., end of every month. The generated code snippet and code snippet lists would then be used to 1. Form a portfolio. Allocate capital to these selected stocks. This involves determining position sizes, e.g., equal weighting, volatility parity, or risk contribution, and ensuring the portfolio remains market neutral for a long/short strategy. 2. Execute trades. Calculate the number of shares to buy or sell for each stock based on the allocated capital. This is where practical considerations become vital. Transaction costs. Account for commissions, exchange fees, and bid-ask spread. These can significantly erode profits, especially for frequent rebalancing or illiquid stocks. High transaction costs can even negate a seemingly profitable strategy. Liquidity. Ensure that the selected stocks are liquid enough to be traded without significant market impact. Trading large volumes of illiquid stocks can move prices unfavorably, leading to worse execution prices than anticipated. Market impact. The act of buying or selling large quantities of shares can affect the stock's price, leading to code snippet, the difference between the expected price and the actual price at which the trade is executed. This is particularly relevant for large-scale trading. 3. Evaluate performance. Track the returns of the form portfolio over the code snippet. This involves downloading future price data, e.g., for August 2022 if the signal was generated on July 31st, 2022, and calculating the portfolio's compounded returns, often comparing it against a benchmark. 4. Rebalance. At the end of the code snippet, e.g., August 31st, 2022, the process repeats. New signals are generated based on data up to August 31st, 2022, and the portfolio is adjusted for September. This regular rebalancing ensures the portfolio continues to reflect the most current momentum signals. The code snippet, or performance period, discussed earlier is inherently tied to this rebalancing frequency. A fixed one-month look-ahead window implies monthly rebalancing. Strategies can also use different look-ahead windows, e.g., quarterly, weekly, or event-driven rebalancing, each with its own trade-offs regarding transaction costs, responsiveness to market changes, and the decay rate of the momentum signal. By carefully defining these periods and implementing the signal generation logic, we lay a solid, robust foundation for building and testing sophisticated quantitative trading strategies. Evaluating out-of-sample performance. After generating trading signals, the crucial next step is to evaluate the strategy's performance on data it has not seen during the signal generation process. This is known as out-of-sample testing, and it is paramount for assessing the true viability and robustness of a trading strategy. Understanding out-of-sample versus in-sample testing. When developing a trading strategy, we typically use a portion of our historical data to design, optimize, and generate signals. This is called in-sample testing. While useful for initial development, relying solely on in-sample results can lead to a phenomenon known as overfitting. Overfitting occurs when a strategy is too tailored to the specific historical data it was developed on. It might capture noise or spurious patterns unique to that dataset, rather than genuine, repeatable market inefficiencies. Consequently, an overfit strategy performs exceptionally well on the in-sample data, but poorly when applied to new, unseen data out of sample data. Out-of-sample testing addresses this by evaluating the strategy on a separate segment of data that was not used during development. This provides a more realistic assessment of how the strategy might perform in live trading, as it simulates encountering future market conditions. For our momentum strategy, this means evaluating the returns of the selected long and short stocks during a period after the signals were generated. Defining the evaluation period. Our momentum strategy identifies stocks based on their performance over a code snippet, e.g., the past 6 months, and then holds these positions for a subsequent code snippet, e.g., the following month. To properly evaluate the strategy, we need to precisely define this code snippet relative to the code snippet. We will use the code snippet module, which provides robust and intuitive data arithmetic, especially useful for adding or subtracting specific time intervals like months or years, correctly handling month-end dates and leap years. Let's assume our signals were generated at the end of a specific code snippet, for example, December 31st, 2004. The trades based on these signals would then be executed at the beginning of the next month, and their performance measured over that subsequent month. Download the code on OnePageCode Substack. In this initial step, we define code snippet as the specific date up to which we've analyzed stock data and generated our trading signals. The code snippet is then calculated by adding 1 month to this code snippet. This ensures that we are assessing the strategy's performance on future data, which is crucial for a realistic backtest. The code snippet function intelligently handles month-end transitions, ensuring our dates are correctly aligned, retrieving returns for long positions. Once the code snippet is set, we need to extract the actual monthly returns for the stocks identified for our long positions. We use Panda's powerful code snippet indexer, combining date-based selection with conditional selection based on the list of code snippet. Download the code on OnePageCode Substack. Here, code snippet precisely targets the row corresponding to our code snippet, e.g., January 31st, 2005. The second part of the code snippet statement code snippet creates a Boolean mask that selects only those columns, stock tickers, that are present in our code snippet list. The result, code snippet, is a pandas series containing the monthly returns for each of the long-selected stocks during that specific evaluation month, retrieving returns for short positions. Similarly, we retrieve the returns for the stocks designated for our short positions. The process is identical to that for long positions, but using the code snippet list. Download the code on OnePageCode Substack. This step completes the data extraction for both legs of our long-short portfolio for the chosen code snippet. We now have the individual returns for each stock we've decided to trade. Calculating net strategy profit/loss. The final step for a single evaluation period is to combine the returns from our long and short positions to calculate the strategy's net profit or loss. For simplicity, we assume an equally weighted portfolio for each leg, equal capital allocated to each long stock, and equal capital to each short stock. Understanding long-short P&L, crucial concept. This is a common point of confusion for beginners. Long positions. When you go long on a stock, you profit when its price increases, and you lose when its price decreases. A positive return contributes positively to your strategy's P&L. A negative return contributes negatively. Short positions. When you go short on a stock, you profit when its price decreases, and you lose when its price increases. This means a negative return for a shorted stock is a profit for your strategy, and a positive return is a loss. Therefore, to calculate the net profit of a long-short strategy, you take the average return of your long positions and subtract the average return of your short positions. Let's illustrate. If code snippet equals plus 5% and code snippet equals plus 2%, long leg profits plus 5%. Short leg loses minus 2% because the stock went up, which is bad for a short. Net BL égale code snippet. If code snippet equals plus 5% and code snippet equals minus 2%, long leg profits plus 5%. Short leg profits plus 2% because the stock went down, which is good for a short. Net P&L equals code snippet. This subtraction correctly accounts for the inverse relationship between stock price movement and a short position profitability. Download the code on OnePageCode Substack. This calculation provides the strategy's performance for a single month. While this snapshot is useful for understanding the mechanics, it's crucial to understand that a single month's performance is not statistically significant and cannot be used to draw robust conclusions about a strategy's long-term viability. Beyond single period. Evaluation. Robust backtesting and performance metrics. Evaluating a trading strategy based on a single month's out-of-sample performance is akin to judging a chef's skill from a single dish. To truly understand a strategy's efficacy, profitability, and risk, we must perform a multi-period backtest across a significant historical dataset. This involves iterating the entire process, signal generation, position selection, and P&L calculation, for every possible code snippet and code snippet in our dataset. The importance of full backtesting. A comprehensive backtest allows us to 1. Assess consistency. See if the strategy consistently generates positive returns across different market regimes, bull, bear, sideways markets. 2. Quantify risk. Measure various risk metrics over time, not just returns. 3. Identify drawdowns. Understand periods of significant capital loss. 4. Compare to benchmarks. See if the strategy truly outperforms a simple buy-and-hold approach or a relevant market index. 5. Account for real-world costs. Incorporate factors like transaction costs and slippage, which can significantly erode theoretical profits. Incorporating transaction costs. Transaction costs are an inevitable part of trading. They include commissions, fees paid to brokers for executing trades. Slippage, the difference between the expected price of a trade and the price at which the trade is actually executed. This is more pronounced for large orders or illiquid stocks. Bid-ask spread, the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. Each round trip, buy and sell. incurs half the spread. For our equally weighted long-short strategy, we might consider a fixed percentage cost per dollar traded. For instance, if we assume a 0.05% cost per trade, buying or selling, then a round-trip, buy and sell, would incur 0.1%. If we rebalance monthly, these costs accumulate. Let's assume a simple fixed transaction cost applied to the total capital deployed in both long and short legs. Download the code on OnePageCode Substack. This simple adjustment highlights how even small costs can impact profitability. In a real-world scenario, you would need to estimate transaction costs based on your broker's fees, the liquidity of the stocks, and your typical trade size. Automating the backtest, a full history of strategy returns. To build a robust understanding, we need to iterate the process over many code snippet/code snippet pairs. This involves creating a loop that moves month by month through our historical data. First, let's encapsulate our single-period calculation into a reusable function. Download the code on OnePageCode Substack. The code snippet function generalizes the steps we've just performed. It takes the code snippet, the overall code snippet, and, crucially, dictionaries containing the code snippet and code snippet selected for each code snippet. This setup assumes that the SIG NAL generation process from previous sections would produce such dictionaries. This function returns the strategy's net return for a single month, optionally accounting for transaction costs. Now, we can loop through all possible code snippet dates in our dataset and collect the strategy's monthly returns. Download the code on OnePageCode Substack. This loop processes the entire historical dataset, generating a time series of our strategy's monthly returns. This code snippet is the foundation for all further performance analysis. Key performance metrics. With a time series of monthly strategy returns, we can now calculate more sophisticated performance metrics. 1. Compound annual growth rate. CAGR represents the average annual rate of return over a specified period longer than 1 year, with the assumption that profits are reinvested. It smooths out volatile returns. Download the code on OnePageCode Substack. CAGR provides a single, annualized number that is easy to compare across different investment strategies or benchmarks. 2. Sharpe ratio, a measure of risk-adjusted return. It indicates the amount of return earned per unit of risk volatility. A higher Sharpe ratio is generally better, meaning the strategy is generating more return for the risk taken. Download the code on OnePageCode Substack. The Sharpe ratio is critical for understanding if your strategy's returns are simply due to taking on more risk or if it truly generates superior risk-adjusted return. Endness. 3. Maximum drawdown represents the largest peak-to-trough decline in the cumulative equity curve. It's a key indicator of downside risk. Download the code on OnePageCode Substack. A large maximum drawdown indicates that the strategy experienced significant periods of capital loss, which can be psychologically difficult for traders and may require larger initial capital to recover. Benchmarking and visualization. Comparing your strategy's performance against a relevant benchmark, e.g., a broad market index like the DJIA or S&P 500, is crucial. It helps answer the question, did my complex strategy truly outperform a simpler, passive investment? Visualizing the cumulative equity curve of your strategy against a benchmark provides immediate insight into periods of outperformance and underperformance. Download the code on OnePageCode Substack. The equity curve plot visually represents the growth of an initial investment over time. Comparing it to a benchmark immediately highlights periods when your strategy is doing better or worse than the broader market, offering intuitive insights into its relative strength and weakness. Capital allocation and portfolio structure. The assumption of an equally weighted portfolio for each leg implies that if you have code snippet long stocks, each receives code snippet of the capital allocated to the long side. Similarly for the short side. For a dollar-neutral long-short strategy, the total dollar value of your long positions ALS, the total dollar value of your short positions. This means your net market exposure is zero, making the strategy less susceptible to overall market movements and more reliant on the relative performance of your selected long versus short stocks. Our current calculation code snippet implicitly assumes this, as it focuses on the difference in performance. Other weighting schemes could include value-weighted, allocating capital based on the market capitalization of the stocks; risk-weighted, allocating capital to minimize portfolio volatility or achieve a target risk level; inverse volatility, allocating less capital to more volatile stocks. These more advanced weighting schemes can significantly impact strategy performance and risk characteristics, but also add complexity. For a foundational understanding, the equally weighted approach is a good starting point. Evaluating out-of-sample performance. Evaluating a quantitative trading strategy's performance is a multifaceted process, with a critical distinction between in-sample and out-of-sample testing. While in-sample testing uses the same data that was used to develop or optimize the strategy, out-of-sample testing applies the strategy to unseen data. This distinction is paramount in quantitative finance. The critical role of out-of-sample testing. Out-of-sample testing is the gold standard for validating a trading strategy's robustness and predictive power. Its primary purpose is to ascertain whether a strategy's observed performance is genuinely due to its underlying logic or merely a result of data snooping or overfitting. Preventing data snooping. If you test a strategy repeatedly on the same data set, you might inadvertently discover patterns that are purely coincidental to that specific historical period. These patterns often do not hold in future, unseen data. Out-of-sample testing helps confirm that the strategy's edge is not just a statistical fluke. Combating overfitting. Overfitting occurs when a model is too complex and learns the noise or random fluctuations in the training data rather than the true underlying relationships. An overfit strategy will perform exceptionally well on historical data, in sample, but poorly on new data, out of sample. By testing on data not used during development, we gain a more realistic assessment of the strategy's real-world viability. In essence, out-of-sample performance provides an unbiased estimate of how the strategy is likely to perform when deployed in live trading. Without it, any perceived edge is suspect. Choosing an appropriate benchmark. To truly understand a strategy's effectiveness, its performance must be compared against a relevant benchmark. A benchmark serves as a baseline, representing the performance of a passive investment or a broad market index. This comparison helps determine if the strategy is generating alpha, returns in excess of what would be expected given its market exposure. What is a benchmark? A benchmark is typically a market index, e.g., S&P 500, Dow Jones Industrial Average, or a portfolio designed to represent a specific market segment or investment style. It provides context for evaluating whether your strategy's returns are merely a reflection of general market movements or if they are attributable to your unique trading logic. Why the Dow Jones Industrial Average, DJIA? For this single period evaluation, the Dow Jones Industrial Average, DJIA, is chosen as a straightforward, widely recognized benchmark. Strengths. The DJIA is a price-weighted index of 30 large, publicly traded companies in the United States. It's simple to understand, represents a significant portion of the U.S. industrial economy, and has a long history, making data readily available. Weaknesses. As a price-weighted index, stocks with higher prices have a greater impact, regardless of their market capitalization. Its limited number of components, 30, means it's not as broad a representation of the overall market as, for example, the S&P 500, which includes 500 companies and is market capitalization weighted. Other common benchmarks. S&P 500 Index, SPY, often considered the most representative benchmark for large-cap U.S. equities. It's market capitalization weighted, meaning larger companies have a greater influence. Russell 2000 Index, IWM, represents the performance of small-cap U.S. companies. Specific sector indices, for strategies focused on particular industries, e.g., technology, healthcare, a sector-specific ETF or index might be a more appropriate benchmark. Treasury bills, e.g., 3-month T-bill often used as a risk-free rate benchmark, particularly when calculating risk-adjusted returns like the Sharpe ratio. The choice of benchmark should align with the strategy's investment universe and risk profile. For a broad market momentum strategy, a broad market index like the DJIA or S&P 500 is suitable. Alpha and beta, briefly. When comparing a strategy to a benchmark, two key concepts often arise. Beta measures a strategy's volatility relative to the overall market. A beta of 1 implies the strategy moves in line with the market. A beta greater than 1 suggests higher volatility, and less than 1, lower volatility. Alpha represents the excess return of a strategy relative to the return of the benchmark after adjusting for the strategy. S-beta. A positive alpha indicates the strategy has outperformed the market on a risk-adjusted basis. While we won't explicitly calculate alpha and beta in this single-period example, understanding their definitions is crucial for more advanced performance analysis. Challenges: long-short strategy versus long-only index. Our momentum strategy is implicitly a long-short strategy. It buys winners and sells losers. Most market benchmarks, like the DJI, are long-only indices. This introduces a challenge when comparing them directly. Capital allocation. A long-only index assumes 100% capital is invested in the index constituents. A long-short strategy might employ leverage or net market exposure close to zero. Risk profile. A long-short strategy aims to be market neutral or profit from relative price movements, potentially having a very different risk profile, e.g., lower beta, different volatility, than a long-only index. Borrowing costs. Shorting stocks incurs borrowing costs, which are not reflected in a long-only benchmark. For this initial comparison, we will simply compare the strategy's profit to the benchmark's return, acknowledging these nuances. More sophisticated comparisons would involve constructing a synthetic long-short benchmark or using risk-adjusted metrics more suitable for alternative strategies. Downloading benchmark data. To calculate the benchmark's performance, we first need to download its historical adjusted closing prices. We will use the code SNP pet library, similar to how we downloaded individual stock data in previous sections. We'll use the same code snippet and code snippet variables established earlier to ensure our benchmark data aligns with the period of our strategy's operation. Download the code on OnePageCode Substack. The code above imports necessary libraries and reestablishes the code snippet, an example code snippet to make the following code runnable independently. In a book, these would naturally flow from prior sections. Download the code on OnePageCode Substack. This segment initiates the download of historical data for the DJI index using code snippet. We specify code snippet as the ticker symbol and provide the code snippet and code snippet dates to fetch data for the relevant period. The code snippet data frame will contain various price data, but we are primarily interested in the code snippet, adjusted closing price, for return calculations. Calculating compounded monthly benchmark returns. Our momentum strategy's profit was calculated over a 1-month holding period. To make a fair comparison, we need to calculate the DJI's compounded return over the same 1-month period. Since the downloaded data is daily, we'll convert daily returns to monthly compounded returns. Download the code on OnePageCode Substack. Here, we compute the daily percentage change from the ADJ close column. The code snippet method is a convenient pandas function that calculates the percentage change between the current and a prior element. The first value will be code snippet, as there's no prior day to compare to. Download the code on OnePageCode Substack. This crucial step transforms daily returns into monthly compounded returns. Code snippet groups the daily returns by month, with the label indicating the end of the month. Code snippet. This is where the compounding happens. For each monthly group code snippet, which is a series of daily returns for that month, code snippet converts each daily return code snippet into code snippet, e.g., a 0.01 return becomes 1.01. Code snippet multiplies all these code snippet terms together. This product represents the cumulative growth factor over the month. Code snippet subtracts 1 to convert the cumulative growth factor back into a total percentage return for the month. For example, if code snippet is 1.05, the compounded return is 0.05 or 5%, extracting the out-of-sample benchmark return. Our momentum strategy's out-of-sample performance was evaluated for the month immediately following the code snippet. We need to extract the DJI's return for this exact same month to ensure an apples-to-apples comparison. Download the code on OnePageCode Substack. In this snippet, code snippet is calculated, though not directly used for indexing code snippet, as it's monthly. It's useful for understanding the timeline. Code snippet. This is the crucial part. Since code snippet labels months by their end date, if our code snippet ends on December 31st, 2020, the subsequent holding period, January 2021, will correspond to a monthly return labeled January 31st, 2021. We use code snippet to correctly identify this label. Code snippet. This precisely retrieves the benchmark's compounded monthly return for the out-of-sample period, allowing for a direct comparison with our code snippet. Visualizing performance comparison. A numerical comparison is good, but a visual representation often provides clearer insights into performance differences. A simple bar chart can effectively highlight the outperformance or underperformance of the strategy relative to the benchmark. Download the code on OnePageCode Substack. This code block utilizes code snippet to create a bar chart. It sets up code snippet and code snippet lists for the two entities being compared. Code snippet creates the bars, and code snippet adds the percentage values directly on top of each bar for easy reading. Titles and labels make the plot informative. The code snippet dynamically adjusts the y-axis to fit the returns and ensure zero is visible. This visualization clearly shows whether the momentum strategy yielded a higher or lower return than simply holding the DJI index during the out-of-sample month. Beyond simple returns, key performance metrics. While comparing a single month's return is a good start, it's insufficient for a comprehensive strategy evaluation. Real-world quantitative analysis demands a broader set of performance metrics that account for risk, consistency, and long-term viability. For this single out-of-sample month, some metrics aren't fully applicable, but understanding their definitions is vital for future, more extensive backtesting. 1. Annualized return. This metric extrapolates the strategy's return over a full year, providing a standardized basis for comparison. For a single monthly return, it's a simple multiplication. $text annualized return equals 1 plus text monthly return, 12, $1. Download the code on OnePageCode Substack. Explanation. This calculation provides a hypothetical annualized return if the performance observed in that single month were to persist for an entire year. While useful for comparison, it's important to remember that extrapolating a single month's performance to a full year can be highly misleading, as returns are rarely consistent month to month. This is why longer backtests are essential. 2. Volatility, standard deviation of returns. Volatility measures the degree of variation of a trading price series over time, often quantified by the standard deviation of returns. Higher volatility implies greater risk. Download the code on OnePageCode Substack. Explanation. For the benchmark, we can compute the standard deviation of its daily returns during the out-of-sample month and then annualize it by multiplying by the square root of the number of trading days in a year, typically 252. This gives us a sense of the benchmark's risk during that period. For our momentum strategy, since we only have a single profit figure for the month, we cannot calculate its volatility. Volatility metrics require a series of returns over a period. This underscores the need for multi-period backtesting. 3. Sharpe ratio. The Sharpe ratio is a risk-adjusted return metric. It measures the excess return above the risk-free rate, per unit of total risk volatility. A higher Sharpe ratio indicates better risk-adjusted performance. $text Sharpe ratio equals \frac \text strategy return \text risk-free rate /text strategy volatility $. Explanation. While a crucial metric, calculating a meaningful Sharpe ratio for a single month's performance is not practical. It requires both a series of returns and a corresponding volatility. We mention it here as a key concept to be applied when the strategy is backtested over many periods. 4. Maximum drawdown. Maximum drawdown, MDD, represents the largest peak-to-trough decline in a portfolio's value over a specific period. It's a key indicator of downside risk. Explanation. Like volatility and Sharpe ratio, MDD cannot be calculated from a single monthly profit figure. It requires tracking the equity curve of the strategy over time. We will explore this metric in detail when we perform full backtesting over extended periods. 5. Cumulative returns. Cumulative returns show the total return of an investment over a period, accounting for compounding. They are essential for understanding long-term performance. Explanation. In this section, we've focused on a single out-of-sample month. To truly evaluate a strategy, we need to calculate its cumulative return over its entire operational history, the full backtest period, comparing it to the benchmark's cumulative return. This allows us to see how the strategy performs over different market cycles. This will be a core focus of future sections where we extend our backtest. Real-world considerations and limitations. Beyond the theoretical calculations, several practical aspects significantly impact a strategy's real-world profitability. Transaction costs, slippage, and commissions. Our current profit calculations are gross returns. They do not account for the costs incurred when executing trades. Commissions, fees paid to brokers for executing trades. Slippage, the difference between the expected price of a trade and the price at which the trade is actually executed. This often occurs in fast-moving markets or when trading large volumes. Bid-ask spread, the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, ask. Each round-trip trade, buy then sell, incurs this cost. These costs, especially for high-frequency or high-turnover strategies like momentum, can significantly erode profits. In real-world backtesting, it's crucial to model these costs realistically. Market regimes. A strategy that performs well in one market regime, e.g., a strong bull market, might perform poorly in another, e.g., a bear market, a choppy sideways market, or a high-volatility environment. Bull versus bear markets. Momentum strategies often thrive in trending markets, up or down, but can struggle during reversals or periods of high uncertainty. Trending versus choppy markets. Momentum works best when prices are moving consistently in one direction. In choppy, non-trending markets, it can lead to whipsaws and losses. Robust strategies should demonstrate profitability across various market conditions, or at least identify the specific regimes in which they are expected to perform. A single period evaluation, by its nature, cannot provide this insight. Limitations of single-period testing. As reiterated throughout this section, evaluating a strategy based on a single out-of-sample period, while a necessary first step, has severe limitations. Statistical significance. A single observation tells us little about the statistical significance of the strategy's edge. Is the outperformance or underperformance truly due to the strategy, or is it random chance? Statistical tests, e.g., t-test, performed over many periods are needed to answer this. Luck versus skill. A single successful period could be pure luck. Only consistent performance over many independent periods can suggest skill. Representativeness. 1 month might not be representative of typical market conditions or the strategy's average performance. To overcome these limita. Tie-ins. The next logical step in strategy evaluation is to perform a comprehensive backtest over an extended historical period, incorporating multiple formation and holding periods, and then analyzing the cumulative performance and associated risks using the full suite of performance metrics. Summary. Consolidating the momentum trading strategy workflow. This chapter has navigated the journey of designing, implementing, and evaluating a fundamental quantitative trading strategy, momentum. We began with theoretical underpinnings, progressed through practical data preparation and signal generation, and concluded with a preliminary assessment of its performance. This summary consolidates these concepts, reinforcing the core principles and setting the stage for more advanced systematic testing. The core concept, cross-sectional momentum. At its heart, momentum trading, as explored in this chapter, is a cross-sectional strategy. This means it identifies assets that have performed well relative to their peers over a defined look-back period and anticipates that this relative outperformance will continue into the look-ahead period. The fundamental premise is rooted in behavioral finance, suggesting that investor underreaction to news or overreaction to past trends can lead to persistent price movements. By systematically identifying and acting on these relative strength differences, traders aim to capture returns from these market inefficiencies, differentiating momentum from trend following. It's crucial to distinguish between the cross-sectional momentum strategy implemented here and trend-following strategies. While both capitalize on price persistence, their methodologies differ significantly. Momentum trading, cross-sectional, focuses on the relative perfo, romance of multiple assets against each other at a specific point in time. For instance, out of 100 stocks, we pick the top 10 performers. The signal is generated by comparing an asset's past return to the past returns of other assets in the universe. The look-back window defines the period over which this relative performance is measured. Trend following time series focuses on the absolute performance of a single asset over time. For example, if a stock's price crosses above its 200-day moving average, it's considered to be in an uptrend, irrespective of how other stocks are performing. The signal is generated by analyzing an asset's price history against its own past values or indicators derived from them. The look-back window in momentum trading defines the period over which past returns are calculated for ranking, while the look-ahead window defines the period for which the formed portfolio is held and its future performance is observed. Understanding these distinct applications of look-back and look-ahead periods is vital for correctly designing and interpreting quantitative strategies. This distinction is crucial for selecting the appropriate strategy based on market conditions or asset characteristics. Cross-sectional momentum might thrive in markets with clear sector rotation or strong leadership, while trend following could be more suited to capturing sustained movements in individual assets or commodities. The workflow of a quantitative trading strategy. Implementing a quantitative trading strategy, as demonstrated throughout this chapter, follows a structured workflow. While the specifics vary, the core stages remain consistent. 1. Data acquisition and preparation. This initial phase involves sourcing clean, reliable historical price data, e.g., adjusted closing prices. Critical steps include handling missing values, ensuring data alignment across multiple assets, and standardizing formats. For our momentum strategy, this involves fetching daily price data and converting it to monthly returns. 2. Signal generation. This is where the strategy's logic is applied to the prepared data to identify trading opportunities. For momentum, this involved calculating past returns for each asset over a defined look-back window, ranking assets based on these past returns, identifying the top-performing momentum assets and potentially the bottom-performing anti-momentum assets. The output of this stage is a set of actionable signals, indicating which assets to buy or sell. 3. Portfolio construction and rebalancing. Based on the generated signals, a hypothetical portfolio is constructed. This involves allocating capital to the selected assets. Since momentum is a dynamic strategy, this portfolio is typically rebalanced periodically, e.g., monthly, by generating new signals and adjusting holdings accordingly. 4. Performance evaluation. Out of sample, this is the critical final step where the strategy's effectiveness is measured using data, not used in its development or signal generation, out of sample data. This chapter focused on a single period out of sample evaluation, calculating returns for a specific period after the signals were generated. For example, we observed that our chosen momentum strategy, when applied to a universe of stocks over a specific evaluation period, generated a positive return, demonstrating its potential to capture profits. This practical outcome reinforces the viability of the conceptual framework. Looking ahead, systematic backtesting. While the single-period out-of-sample evaluation provides an initial glimpse into a strategy's performance, it's merely a starting point. A robust assessment requires systematic backtesting. This involves simulating the strategy's performance over extended historical periods, across various market conditions, and often with different parameter sets. The next chapter will delve into the intricacies of systematic backtesting, covering topics such as developing a comprehensive backtesting framework, calculating a wide range of performance metrics, Sharpe ratio, Sortino ratio, maximum drawdown, alpha, beta, addressing common backtesting pitfalls, such as look-ahead bias, survivorship bias, and overfitting. By building upon the foundation laid in this chapter, you will gain the tools to rigorously evaluate and refine quantitative trading strategies, moving beyond simple demonstrations to professional-grade analysis.